extend our welcome to our chairperson CA Revati S. Raghunathan ma'am and our past chairperson CA K. Ravi sir. To kindly proceed the beginnings, I request the members to rise up for our ICI motto song.
Yaesha supteshu jagrati Yaesha supteshu jagrati Kamam 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 kavusho Purusho nirvimana nirvimana Tadeva shukram Tada brahma Tada brahma Tadeva mritamujjate Tasmin lokaha shataha Sarve tadunatyati kaschan Etadvaita 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 Etadvaita.
Thank you. Please be seated. To formally set the tone for today's deliberations on the Metro Conference, I have the honor of inviting our chairperson, CA Revati S. Raghunathan ma'am, to deliver the welcome address.
A very warm good morning to everyone here. A very special and warm welcome to Shailesh sir, Haribhakti sir, who I have been, following up rather frequently, requesting him to come here and address the members. And thank you very, very much, sir, for accepting our invite. We do hope that once you will come physically for us and physically and address all our members. I have huge respect for sir and his thought processes, and a very warm good morning, welcome, and thank you to our past chairman, C.A.K. Ravi sir, who has actually enabled me to reach out to all the outstanding speakers of the day. And like I said, I have been requesting Haribhakti sir, rather frequently to come here and address the members, and I thought what better day, what better topic than budget. Sir's thought processes are always a little different from the way that we think, and I think his economic thought processes are, very, very, I would say, thought-provoking, very radical, and, as chartered accountants, we don't actually think too much about economics or the economic impact of all the decisions, the economic impact of the work that we as chartered accountants do, but economic, the economy of the country depends to a very large extent on chartered accountants, and we somehow are of the opinion, most of us, I wouldn't say all of us, most of us are of the opinion that, okay, if I enable direct tax collections or if I enable the indirect tax collections, I have contributed to the economy, but I seriously don't think so. As we mature in the profession, our thought processes about the impact of the work that we do changes a lot. And if people here are not following Haribhakti sir's writings and thoughts, I suggest that you all follow him. He has, you have all heard of Modinomics, but the Harinomics is something which he writes about quite a lot. And it kind of opens your mind to whatever, how everything is being impacted. And he was also part of the Davos team, and he works a lot along with the government. And I would say that he is one of the torch bearers of our profession. And we all only think or know of him as a partner in Haribhakti and Co. But he is a partner of Haribhakti and Co. That is his foundation. But I think that the work that he is doing along with the government and for the economy and for sustainability is something far, far beyond all that. And so I couldn't think of anybody else to speak about the budget and beyond today. And then we are having Mr. P. Daniel from IBBI. He's CAP Daniel. He's a full-time member of, NFRA. And, this thought, in fact, he called me again yesterday. He's been asking me repeatedly, Madam, you've named this day as budget and beyond. So why are you calling me? NFRA is here to stay. And NFRA is definitely going to have a huge impact on all the work that we as auditors are going to do. Chartered accountants are signing. And I feel that, instead of being resistant to our regulators, we should actually welcome them. And we should have a, cordial handshake with all our regulators, because regulators ensure that whatever is the work that we are doing is actually within the boundaries of whatever the government is expecting us to do. So, even I was of the opinion that NFRA is actually, here to dilute our profession, and they are, going to make it very difficult for us to operate within the professional boundaries. But I happened to go for a session, for a day conducted by NFRA in Bangalore, and there immediately I had a total change of thought processes. Because, one, NFRA is not going to replace us chartered accountants. It's only going to replace the certain regulatory aspects. And they're going to do it along with the ICAI. And they also have a lot of very valid ideas, thoughts, and they're issuing a lot of guidelines and circulars. And I feel that, if we understand what is NFRA's role, and understand the perspectives of NFRA, it will help us a very long way in actually refining the way that we deliver our professional work. See, sometimes we get complacent about whatever we are doing, and that complacency, we think that, no, this is how I'm going to do, this is what I have been doing. They are introducing, as it is, we have so many dynamic laws, and keeping up with all the laws, it's so difficult, the changes in all the laws. So why exactly would I go through whatever NFRA is telling? But I think that NFRA is a body which we have to actually collaborate with, understand, and we can't always hide behind the fact saying, I'm too small a person, NFRA is not going to come and look at me. Someday NFRA will come down heavily on all of us if we are not going to follow whatever it is that the government is expecting us. See, NFRA is also a body which has been brought in by the government, so let us accept. Why should we be resistant to everything? Let us accept and let us actually move on, collaborate with them, take their ideas, take their perspectives and move on. And of course, for the tax sessions in the afternoon, we have Advocate Rohit, Jain and CA Vishal, Gada. They are speakers who generally don't come down to Chennai to speak, and again I'm deeply indebted to Ravi sir for actually bringing such high profile speakers to speak to us today. It is not like we do not have high profile speakers in Chennai, but sometimes it's a different perspective will also trigger thought for us. There are, we meet all our own professionals here day in and day out, and we have exchange of ideas and networking with them. So calling someone from a different place with different ideas and interpretations of the same amendments is going to actually help us change our thought processes. So with this, I want to say thank you everyone for coming here and registering. There are still a number of more people who are coming, but of course, Chennai being Chennai, and it's slightly cooler, and we all like to enjoy the cool weather of Chennai by snuggling in our bed and trying to come in a little later. So I would like to give a formal introduction of Sir Haribhakti sir. He needs no introduction, but like I said, we have to actually know him beyond Haribhakti and Co. So he's a pioneering advocate of ESG, CSR and sustainability with a 5-decade career as a chartered accountant and a cost accountant. He has championed the integration of technology with sustainability through his groundbreaking Innovate to Zero concept, ensuring every intervention creates focused, far-reaching and cooperative impact. As chairman of numerous ESG, CSR, and sustainability committees across leading boards, he has consistently driven green transformation and shared value creation. He actively promotes sustainable enterprises through his own firm and leadership roles, and he is recognized globally for with the sorry, I need to wear my glasses, with the GCBD designation and Vivekananda Sustainability Award. And he continues to influence ESG policy, boardroom strategy, and public discourse through teaching, writing, and thought leadership. A prolific writer, Shailesh has co-authored 5 influential books: Digital Professional Audit Renaissance, ESG, AI Auditing, and Sustainable Abundance. These works reflect his forward-thinking approach to governance, technology, and sustainability. He is also actively pioneering the use of artificial intelligence to drive transformative change in several organizations. I think this is just skimming the surface of whatever Sir is doing and contributing. And I'm deeply grateful to you, Sir, for actually accepting our invite. And I hope we will be able to meet you in a physical program someday, whenever your time permits. Yeah, and just before I hand over the proceedings to Shailesh, Sir, I would like to request our past chairman, C.A. Ravi, to say a few words. Thank you.
Shailesh ji, namaskar.
Namaskar.
I know I've been chasing you too much.
No.
I've gone through his writings on this subject called Harinomics, which he writes on TIOL, and I found it to be wonderful. A different kind of thinking. And therefore, I told Revati Madam that we'll go to Delhi where he was to deliver a talk. We'll meet him there and ensure that he comes to Chennai to deliver the talk. The physical presence has not happened, but the mental presence is here, and you have technology to take us forward. There's something very interesting, between me and him. One chord that I could touch is that my father knew his father very well. So that chord is something which I will hold on to for my lifetime to ensure that whatever I want, I get done from this gentleman. But I find that his thought process is completely different. You may agree, you may not agree. That's a different matter altogether, but his thought process is different. Not the typical budget meeting saying that this, layout here should be more than that and all that. He was sitting right in that hall when that lady was talking on that EU trade deal. The person who signed the trade deal between EU and India. He was also at Davos. So he has a complete view of everything, a ringside view if you want to call it. And therefore I've asked him to talk on the EU trade deal also and how it will affect India, as also a few words on his Davos trip. Plus between last night and this morning when he got up, he found Trump had completely somersaulted. He said, no, I'm coming down to 18%. And some unilateral statements made by him saying that India has agreed not to buy Russian oil. These are things which have a long-term impact, not a short-term impact, but a very long-term impact, not only on trade relations, on inter-country relationship and the global disruption that is happening. I would request him to talk on all that, and with that, thank you, Shailesh, for having accepted my invitation. He has one other aspect which I must tell you. He's a big Shiva Bhakta. So if you want him to stop talking on this and talk on Shiva, he can do that. Thank you.
Thank you very much.
Thank you, CA Revati S. Raghunathan ma'am and CA K. Ravi sir, for the insightful opening remarks and for introducing our speaker of the session, CA Shailesh Haribhakti sir. Moving to our first technical session, to ensure we benefit from the highest level of expertise on the recent budgetary changes, our first speaker, CA Shailesh Haribhakti, will be joining us. So, thank you, sir, for joining us through the virtually. And so, without further ado, I hand over the session to you, sir. Thank you.
Thank you very much. I must first thank SIRC for inviting me to speak this morning. I'm deeply indebted to Revati ji. She is such a dynamic chairman that you have. I've hardly met chairpersons from across the country who have the enthusiasm, commitment, and dynamism that she exhibits. Keep it that way. I'm very delighted for you and for SIRC. And what can I say about Ravi? He is an absolutely great intellectual, super friend, and absolutely great uh, person who will bring SIRC to every height that he can. So I'm deeply indebted to both of you for having invited me. And to all my friends and fellow chartered accountants in Chennai, I wish I could have been there, but unfortunately, post budget, there are multiple commitments that have to be met physically in Mumbai. But with that little tone of gratitude, let me begin. And I have entitled my talk today as India's quiet ascent. We have moved from arithmetic to architecture. It's an absolutely fundamental shift that our country has made. And let me walk you through the mind map that I have developed to make this actually possible. I'm speaking not just about the budget, as Ravi rightly mentioned, not even about markets, which have given us a 1,000 point salute this morning, or the trade deals. And we should start with UK, we should move into EU, and then into the impact of the trade deal that has happened this last night. Half the night we were all awake listening to various people commenting on how this trade deal is going to transform India. But I'm going to talk about a moment. Moments in history are rarely announced with triumph, with trumpets or triumph. They are recognized later in hindsight when patterns suddenly reveal themselves. I believe we are living through one such moment for India. Our patterns are changing. We did not get cowed down by the bullying that we were submitted to. We did not get cowed down by the pressure that was being brought upon us. In fact, we used that as a lever to sharpen our instincts. We closed the UK deal with Prime Minister Starmer. And that was a very important deal because after being a colonial vassal of Britain, for us to have signed a deal on equality with United Kingdom was absolutely fundamentally altering the way that we think about ourselves. And then I remember hearing Ursula in Davos. She was so forthright. At the end of her speech in Davos, which was an extraordinary speech, she mentioned that next week I'm going to India. And she was very much here for the Republic Day celebrations. And they signed what is called the mother of all deals, the EU-India Free Trade Agreement. I must at the same time compliment Mr. Piyush Goyal, a fellow chartered accountant who I've known for many, many years. He has worked relentlessly on these three deals. So we should be proud as a profession that one amongst us was so fundamental in getting to India these three trade agreements. But above all, we should be thankful to our Prime Minister, who, despite all the pressure, withstood it and was able to turn India into a powerful source of deep and great and enduring value. And I think the greatest compliment actually goes to each and every one of us sitting in this room and to all the thousands and millions of engineers that India has. We will see a strengthening rupee. We will see a market that is going to get invested in by not only persons of Indian origin, as our budget encourages, but by people from all over the world who had taken a holiday from investing in India. Last year, they took profits. This year, they will crowd in investment. I want to start by just one very major insight that I got from this budget. This budget is not about giving up revenue sources at all. There is no change whatsoever in the revenue momentum. What is being done is that future revenues that might have come if we had not amended are being sacrificed. The 22-year tax holiday for companies which will establish data centers is an innovation that we are seeing for the first time in the fiscal history of India. Ladies and gentlemen, we should salute this because it has not sacrificed anything that we have. It is only marking India's arrival on the timeline of nations which will be great. Just imagine where the latest new giga data center is called Hyperion. It is being set up by Meta, which was earlier Facebook, in Louisiana, a state in the US, which was the only place on the planet where Meta could have had access to the millions of barrels of water that they will need to run the data center and to have access to 5 gigawatts of power and land, sufficient land to make sure that the data center can come up. A giga data center takes acres upon acres of land. They set it up in Louisiana because the fundamentals of power and water were made available in Louisiana. In India, just imagine a Hyperion coming up because 10 great Indian companies or 5 great Indian companies and 5 great global corporations come together and establish on a source of 5 gigawatts of power a massive data center. It takes maybe 1.5 years. If you're doing it at Trump time, at Elon Musk's time, you might be able to finish it much faster. But ordinary human beings would take 1.5 to 2 years to establish a giga data center. Now that can be established. India has proved that we can, in Gada, in a place in Saurashtra, we are putting up 30 gigawatts of renewable power. Not all of that has been committed. Not all of that needs to go into the grid. We could have a 5 gigahertz consuming data center right there. Just imagine the possibilities that that opens up for India. So therefore, these are not isolated events that we are seeing. They are signals. Signals that India has crossed an invisible threshold from responding to the world to reshaping it. You know, Mark Kearney said in his speech at Davos that if you're not, you will be, if you're not part of the whole participation in the restaurant, you'll be on the menu. Whereas India is now setting the table. We are not waiting for anybody to give us permission to do anything. Without any fear, we permitted the entire set of African nations to enter into the G20. We were the ones who invited it without asking anybody's permission. It was a massive show of newfound power to shape the world, to set the table. That, ladies and gentlemen, is something that we now need to recognize and participate in and feel proud about. Well, let me share with you some of my memories from Davos. India went to Davos in the past seeking capital, partnerships, validation. This year, something was completely, palpably different. India was not pitching it was being studied. Maharashtra declared that we will set up one of the largest data centers, 11 trillion rupees in Maharashtra. We declared that we are going to turn Mumbai into an ecological city. Can you imagine Chennai turning into a ecological city with clean water and clean air? That's what has been committed at Davos. And that is why the whole world was studying us. It was so impressive to be in the room where this announcement was made in the presence of the Chief Minister of Maharashtra and Mr. Chandra of Tata Group. At the highest level, there seemed to be a desire to truly partner with industry to make the deep changes that our country is now ready for to actually happen. Conversations were no longer about potential, they were about execution. No longer about promise, they were about proof. Global investors, policymakers, and CEOs were asking a different question. How is India managing to grow, integrate, digitize, decarbonize, and still retain macro stability? The one recurring thought that has been discussed over the last few weeks, over the last few days on the budget, is that we have unbelievable macro stability. There's no other nation on the planet which is growing so fast with such contained inflation, with the fiscal deficit coming down to the promised levels, and also enjoying now a reversal in the currency's direction. Because we have finally convinced the whole world that we are investable. Because of these trade deals, because of our posture at Davos, we have now convinced the whole world that we are investment worthy. And that's something that will reflect for the benefit of every one of us sitting in this room. Because who's going to execute these projects? Who's going to create the systems and processes that they will doubtless require? Who's going to audit them? Who's going to file the tax returns? Every one of us sitting in this room. So the answer to that question that was posed at Davos lies in the title of my talk. It lies in architecture. And this budget is about architecture. The 26-27 budget has to be recognized as a budget which is changing the architecture of our great nation. And that is why it will be historic. It will be a game changer. It will be a watershed budget. This is not a budget, it is a blueprint. Ladies and gentlemen, I think we need to get away, as Ravi again mentioned in his opening remarks, from the fine print and the debate and the discussion and whether this advantage or that advantage will come or not come. But look at the architecture. All budgets are usually judged by what they give away. This one must be judged by what it builds. The greatest insight, as I told you, is that almost every meaningful incentive, relief, and reform is placed in the future, not in the past. It does not take anything away from the past. And this is the tax exemption is not a sock to data centers. It is a declaration that India understands technological time. Data centers, AI compute, digital infrastructure, these do not yield returns in annual cycles. They compound over decades. Policy has finally aligned with long duration capital. So let's look at the 5 forces that will drive our country to glory. They are structural forces rooted in this budget that will define India's trajectory for the next 2 decades. These are not schemes, they are shifts, they are platform shifts. They are so fundamental to the way that we will actually live our lives in the next few decades. So, what's the first force? The first force is corridors as the new national spine. We are building corridors. Just as we have 108 massive arteries running through us, India is building its corridors, high speed rail connections, dedicated freight corridors, expanded inland waterways, 20 inland waterways, tourism circuits for Buddhism, for creating India's soft power afresh, rare earth value chains, something that, there's no country on earth except China which has taken away 90% of the market share of processing the rare earths. That is what gives China its clout and power to price, because it has cornered 90% of the processing capacity of these rare earths. India can now play a big role in that. And we'll see many rare earth summits coming up. In fact, 2 weeks down the line is a rare earth summit, which is being convened only to find where we can take our position of strength. Chemical parks, biopharma clusters, and the list goes on. This is truly civilizational. It is truly mind-boggling how this budget has identified the corridors as the arteries. It is new thinking. It's called corridor thinking. It's physical, it's sectoral, and it is digital. All three. Corridors, what do? They compress distance. They reduce logistics costs because you reach everywhere much faster than you ever expected. Goods reach everywhere, people reach everywhere. Everything reaches faster. They turn science into scalable production. And here is the critical insight. These corridors will generate surplus, which will be paid as tax. That is where the big ticket change is likely to happen. They will mature into REITs, REITable propositions, monetizable assets, producing stable cash flows that can be recycled into next wave of national investment. You might have noticed in the budget that the PSUs are expected to monetize their assets, convert them into REITs, and create the cash flow required for their next level of investment. Now, that is a new recycling of our already invested wealth. Next wave of national investment will come from this source without any fiscal strain at all. It's completely independent of the fisc. This is sovereign balance sheet thinking. First time I'm noticing that India is thinking in terms of its sovereign balance sheet. With the US and EU trade deals now in place, these corridors no longer terminate at India's borders. They plug directly into global value chains. India will export not just goods, but velocity. That is what these trade deals are all about. We are going to export at a rate, whenever countries faced massive supply chain disruptions, they turned to India. And India always had an answer, whether it were vaccines, or it was rare earths, or it was even energy. All of this, India played a huge role. The second force, ladies and gentlemen, is AI infrastructure and the new digital world. It quietly acknowledged a profound truth, our budget. Intelligence is now a factor of production. Please remember this one line if you remember nothing else from this talk. Intelligence is now a factor of production. It is becoming ubiquitous. It is growing at a pace that humankind never knew. And it is there for all of us to embrace and combine with and work with and take forward. AI infrastructure today is what power plants were in the 1950s. Compute capacity, trusted data centers, digital public infrastructure, integrating identity, consent, payments, and governance. That's what our country is becoming. Multilingual AI platforms like Bharat Vistar. You heard the speeches of the finance minister in your own language because of Sarvam AI on first. In the same intonation that the FM might have used if she was speaking in Tamil. It was extraordinary to experience the FM speech in multiple languages. They did 4 this time. The next time they want to do all 18 languages, critical 18 languages. Together, this forms a sovereign AI ecosystem. India's unique advantage is not just talent or scale, it is trust architecture. In a world worried about data misuse, algorithmic opacity, and digital authoritarianism, India offers something rare. Democratic, rule-based, population scale digital systems. I happen to be chairman of a company which is doing only this work, creating the digital public infrastructure and the digital public goods for India. And it is a joy to see how innovation flourishes when scale meets talent. With global partners now locked in through trade pacts, India is positioned to become the most trusted large-scale AI deployment economy in the world. Our minister at Davos said that India is not going to be wasting its energies in replicating LLMs. India is going to go to the topmost part of the value chain, and it is going to become the highest ROI delivering nation by use of AI. And that is now indeed possible. The third force is a tax and customs system built on trust. This has been transformational. Nobody has commented on it. I'm shocked. The way that we have revamped our customs infrastructure is absolutely exceptional. This budget is fundamentally switching the way goods will move in and out of India. Fundamentally. It is the most understated thing that this budget talks about. In addition, what all have we done? We have rationalized TDS rates. We have decriminalized technical offenses. We have made penalties proportionate. We have extended return timelines. Risk-based customs processes have been established. Litigation will vanish. I think we will see a considerable drop in litigation. The message is unmistakable. We trust first. We verify intelligently. This investment in trust capital is completely transformative. Trust raises voluntary compliance. Compliance lowers litigation. Lower friction increases the risk-taking capacity of our nation, and risk-taking fuels entrepreneurship. By removing what I often call regulatory cholesterol, the state is releasing pent-up entrepreneurial energy that has long been trapped in defensive behavior. Fourth force, employment at scale with dignity. India's employment strategy has finally become multidimensional. Global capacity centers, all of which you have seen in Chennai, are evolving from back offices to global nerve centers, handling analytics, engineering, AI, and strategic decision-making. MSMEs, supported by professional institutions. This is the first time I heard ICAI and ICSI being recognized in the budget speech of the finance minister. We will be assisting to create the systems and processes which we talked about. Digital compliance frameworks and growth funds all are becoming available to MSMEs, and they are being positioned as distributed engines of opportunity. Manufacturing scale up across semiconductors, electronics, biopharma, rare earths, chemicals, capital goods, textiles, and agri value chains creates employment with depth, not just numbers. Trade deals amplify this totally. All of this gets amplified because of the trade deals. EU access lifts textiles, leather, footwear. US reciprocity supports services and advanced manufacturing. Aspiration is finally meeting architecture. And the fifth force, ladies and gentlemen, is infrastructure with fiscal maturity. Markets smiled this week, not because of exuberance, but because of coherence. We had a little blip with the STT giving us some jitters, but we are back up. We are back at where we were and are sailing forward. Capital expenditure will remain robust. Fiscal deficit trends are downward. Debt follows the credible glide path, and asset monetization and PSU dividends will reallocate capital efficiency. 3.25 lakh crores will come into the government's treasury from Reserve Bank of India and PSU dividend as expected by this budget. This is not austerity. This is confidence without bravado. Growth without macro stability is fragile. Stability without growth is sterile. India is doing both. It is doing growth with stability. And why did the markets respond? The markets are not only emotional, they are analytical as well. They see an India that builds infrastructure without fiscal recklessness, opens trade without surrendering sovereignty, deploys technology without eroding trust, and encourages enterprise without chaos. A stronger rupee is not a target, it is a consequence. A 1,000-point rally is not applause, it is acknowledgement. India is not just growing fast, India is learning how to grow well. So, ladies and gentlemen, let me summarize our quiet ascent. Individually, these forces are powerful. Together, they are irreversible. The five forces that I mentioned. Corridors move goods and people. AI moves intelligence. Trust moves trade. Employment moves aspiration. And fiscal maturity moves global confidence. Our budget 26-27 marks India's transition from scale to sophistication, from control to trust, from ambition to execution. India is not advancing noisily, my friends. It is ascending structurally. And when history looks back, it may well say, this was the moment India stopped chasing the future and began shaping it. Thank you. Jai Hind.
Thank you, sir, for enlightening us on explaining future revenue models. Are there any questions?
Thank you very much, sir. No questions means that your topic has actually given everyone too much food for thought. And by the time we process and actually understand and come out with questions, I think we would be taking up too much of your time. Just 1 minute.
Yeah.
Both indirect taxes as well.
Reduction in litigation, is it applicable for direct or indirect taxes?
Both, absolutely both. We are changing architecturally. The mindset of the CBDT has changed. We do not want to go after people to find faults. We want to make GST faceless. That's the next reform that you will see coming about. And you will see that the directions which are being given to the officers, who are the revenue officers, are completely different from what they used to be. Everything is becoming digital.
Thank you.
Yeah. Anyone else? Okay. So thank you very much, sir, for sparing the time to come and join us. And, you have actually redirected the path of our thoughts towards a more progressive India who's come here to stay on the world map. And I think if Abdul Kalam was here, he would not call us as partners in nation building. He may change it to partners in the world economy, building the world economy, leading right at the top. Thank you very, very much, sir. We are deeply grateful and we hope to see you physically soon addressing the members in SIRC.
Yeah, absolutely, Revati. Thank you and stay blessed and all the very best to you.
Thank you, sir. Thank you very, very much. Yeah. Thank you very much, friends. We have the speaker for the next session, but I think, sir, can we break for tea? Yeah. So we'll break for tea and then we'll move on to the session to be addressed by Mr. CAP Daniel from NFRA. And friends, I would just like to inform all of you that SIRC is the proud recipient of the second best regional award from ICAI. And this is very much due to the support of the members, which helped us to achieve this space.
I request our chairman, CA S. Revati Raghunathan, to hand over the memento to our speaker, CA Daniel. I request Dr. CA Abhishek Murali, RCM, SIRC of ICA, to adorn the shawl. I request our chairman to hand over the memento to our speaker. I request our chairman, CAS Revati Raghunathan, to give few words about the speaker.
Yeah, a very warm good morning again to everyone. At the outset, my gratitude to CAP Daniel sir for actually accepting as soon as I invited him for a session today. He had his doubts. He called me yesterday also and asked me, ma'am, tomorrow is a budget session. Are you very seriously calling me to speak about NFRA? Whether it's a budget session or an audit session or anything, I think that we will always welcome NFRA's perspectives and you coming here to share, because I think this is the first time an officer from NFRA, a full-time member from NFRA, our own chartered accountant, who's come here to address us, because there's always this hesitation and this fear about NFRA. And in fact, even I was thinking that NFRA is, all the things which we read about NFRA in the newspapers, all the negative remarks, the way that members and firms are being punished for all the whatever is the transgressions which are being identified. And we all do know that it may percolate down to all levels of chartered accountants. But when I went for this session, which was addressed by NFRA, I realized that, they have been demonized too much. And it was actually a great pleasure to hear the chairman and Daniel sir there in the meeting which I attended in Bangalore. And I got a lot of confidence in us as professionals and for the profession, like how today morning when Haribhakti sir said that, we are going to be the leaders in this budget 2026. So similarly, when you hear the views of NFRA, Instead of just thinking of them as a regulator, let us also think of them as friends who are going to guide us and ensure that we do not step on the toes of any of the stakeholders, because ultimately our responsibilities are towards the various stakeholders. And Sir and the chairman also addressed in WOFA, and there were a lot of questions which were posed to them. So Sir is, told me I welcome all questions. So please do raise any doubts, any queries you have about NFRA, its roles, its expectations, its perspectives, and what is it that NFRA actually expects from chartered accountants. And notwithstanding, we may not all be signing any MNC balance sheet. It's okay. Whatever balance sheet we sign is going to impact some stakeholder somewhere. And I think if we follow the guidance given by NFRA, it's actually going to enable us, to actually do justice to our job and justice to the expectations which is placed on us by the government and by the regulators, because the regulatory bodies do not come into being on their own. It's only a government-enabled regulator, and this is NFRA and ICAI are holding hands and acting. We cannot say that ICAI's powers are diluted or NFRA has got too much of powers. It's not like that. Both of them are hand in hand and they are working together. Maybe the sizes of the balance sheets would be different and the expectations would be different, but finally, they both are working to the same cause. So if, don't think that NFRA is going to bring some disciplinary action against me. No, it is not so. It's only when we are transgressing something. So let us listen, and if any of you have any doubts, please feel free to ask them. Sir is here to clarify all the doubts, and I don't think that he's going to say that this is too small a doubt or this is too big a doubt and too complex. Whatever it is, please do ask, because whatever you ask will benefit everyone else who is here. So thank you, sir, once again for coming. I'll give a brief profile of Mr. Daniel. So, sir, I told you, is a chartered accountant. He joined NFRA as a full-time member on 23rd July 2025, bringing 35 plus years of distinguished government service. A 1998 batch of Indian Defence Estate Services, IDES officer. He's professionally qualified as a chartered accountant and a cost and management accountant, and he has extensive experience in administration, audit, budgeting, including litigation and complaints management. As CEO of the Cantonment Boards and Defence Estate Officer, he improved the financial health, resolved encroachments, led digital transformation of land records, represented India in global anti-corruption forums, and is a 4-time recipient of the Army Commander GOC in C Commendation Medal. Sir has been a torchbearer of the profession, and over to you, sir. Thank you so much for accepting our invitation and honoring us with your presence. Thank you.
Thank you, ma'am. So we would like to invite the speaker of the session, Mr. CAP Daniel, to address us on the role, vision, and evolving regulatory framework of NFRA. Members are requested to kindly keep their phones on silent mode. Thank you.
Yeah. Okay. Thank you. Respected Chairperson of SIRC, CA Revathi Raghunathan, Regional Council Member, CA Dr. Abhishek Murali, distinguished members of the profession who are gathered here for this conference, ladies and gentlemen. I am grateful for this opportunity to interact with you all, professional accountants of the Institute, through this program. The role and contribution of the Institute of Chartered Accountants of India and its members over the years have been extremely significant. The accounting professionals have contributed immensely in the nation's development. Firstly, by laying the foundation for robust financial reporting framework and nurturing its rise as high-quality financial reporting framework. Secondly, in the area of taxation. Thirdly, in statutory audit of companies, banks, insurance entities, corporations, and so on. India today has emerged as the skill capital of the world in the area of financial reporting services. thousands of accountancy and finance professionals are not only gainfully employed across the world, but also are a source of export earnings for the country. The ICAI has played a pivotal role in developing and training technically competent accountancy professionals. Beginning with just about 1,700 members in the year 1949, today it has a family of about 14.5 lakhs, including 4,50,000 members and students as on 31st December of the last year, 2025. This makes it one of the largest professional accountancy bodies in the world today. The auditors are considered as belonging to a profession rather than simply a commercial endeavor, business or industry. The reason is that their core responsibility is to serve the public interest. The work of the financial statement auditors fundamentally serves investors and the public interest. They represent the moral backbone of the capital markets, and it's critical to ensuring that investors have trust in the financial statements. It indeed stands as one of the most respected profession. In this deliberation, I think I've been given a time of about 45 minutes in this deliberation. I will trace the global evolution of independent audit regulation and its trajectory in India, culminating in the establishment of the National Financial Reporting Authority, NFRA. I will examine how India's NFRA's recent transition from a purely reactive enforcement body to a proactive partner is adding significant value to the professional community. Furthermore, I will analyze this shift through the lens of the 2026 budget, highlighting how NFRA's initiatives are actively reducing the compliance burden on professionals while institutionalizing a world-class financial reporting ecosystem. Let me now take you to the story of how the role of professional accountants evolved around the world. A series of incidents, you may label them as scams or frauds, took place around the world, resulting in the birth of audit committees, independent directors, and statutory auditors. Great importance was given to publishing of financial statements based on accepted and uniform standards. Over a period, it gave rise to the need for independent regulators to regulate financial reporting and ensure quality auditing. History teaches us that audit regulation has almost always been shaped by failure. The transition from regulation to independent oversight was not a choice, but a necessity born out of crisis. As early as in 1925, Ivan Kroger, a Swedish engineer, masterminded a fraud in Kruger and Toll. This company controlled approximately 75% of the European and American matchbox market. They also controlled the famous telephone company, the Ericsson brand of telephones, which had factories in 12 countries. They established more than 150 subsidiaries across Europe and in the USA, with each of these subsidiaries having a different auditor. During the 1920s, the company loaned hundreds of millions of dollars to cash-starved European governments to help them to rebuild their war-torn economies. To raise funds from the market, they sold stocks and bonds offering a 20% dividend. This was a classic pyramid or Ponzi scheme where dividends were paid out of capital and the money from subsequent loans and bond issuances were used to repay initial investors. Over a period of time, new investments reduced, resulting in Kroger running out of cash to pay dividends or repay loans. Pricewaterhouse submitted in their investigation report that the accounts of around 142 subsidiaries reporting an income of 1.17 billion US dollars were intercompany transactions and were fictitious. Each subsidiary showed a rosy picture in its financial statements when taken as standalone, but on consolidation basis, the bulk of the income was bogus. The financial loss to the investors was estimated to be around $400 million US. During the same period, an Italian immigrant by name of Philip Musica, who was a known bootlegger, used his bootlegging profits to buy the McKesson and Robbins, a 90-year-old company that sold various products. During the next 12 years, Musica built a pharmaceutical distribution network to inflate McKesson and Robbins' reported assets while skimming cash into his own pockets. Musica enlisted the help of his three brothers, younger brothers, who are in charge of fictitious sales agency companies. In the process, he also created non-existing business divisions, fictitious sales, inventory, and trade receivables. They created bogus documents like bill of lading, bank statements, bank confirmations in the name of real companies and banks. This fraud came to light in the year 1939. Both these frauds, the McKesson and Robbins and the Kruger and Toll, resulted in passing of the US Securities Act 1933 and the establishment of the Securities Exchange Commission in 1934. It led to significant changes in procedures in financial reporting and auditing. The Securities and Exchange Commission recommended that non-office members of the client's board nominate the auditors, and the auditors be elected by the shareholders and also submit the audit report to the shareholders. This was the genesis of the institution of audit committees, independent directors, and statutory auditors. There were a further series of events in the late 1900s that resulted in the passing of the Sarbanes-Oxley Act, the United States of America, in the year 2002. This law was a direct response to several major accounting scandals, most notably the collapse of Enron and WorldCom, which I will discuss in the following slides. The purpose of this law was to protect investors from fraudulent accounting activities by public corporations. These and the related frauds resulted in the establishment of PCOB in the US, which is known as a Public Company Accounting Oversight Board. The establishment of PCOB marked the arrival of audit regulators independent of the accountancy profession. Across the globe, many other countries such as Japan, Singapore, UK, EU, South Africa, and Canada, among others, also established independent audit regulators. Thus ended the centuries-old system of self-regulation by the accountancy profession. One of the most critical of these big scams has been Enron, the energy giant, using fraudulent accounting practices to hide billions in debt and inflate earnings, leading to its bankruptcy in 2001 and dissolution of its auditors, Messrs. Arthur Andersen. Due to stock manipulation, they artificially inflated share prices. The fraud resulted in investors losing billions of dollars and employees losing jobs and their retirement savings. They adopted what is known as mark-to-market accounting. This accounting method allows companies to record projected profits from long-term contracts as current earnings. Enron abused the accounting system to book future income as immediate revenue. The executives of Enron used schemes like round tripping, where they would trade assets back and forth with other companies to artificially inflate revenue. Thanks to the vice president of the company, Sharon Watkins, acting as a whistleblower, the Securities Exchange Commission began an investigation. The share price plummeted from about $90 to $1. The shareholders are estimated to have lost $74 billion. A large number of employees not only lost their jobs, but also their entire retirement savings invested in the stocks of Enron. Enron filed for bankruptcy. Another hard-hitting scam has been the WorldCom, which grew rapidly during the 1990s through numerous mergers and acquisitions, becoming the second largest long-distance telecommunication company in the United States. The executives of this organization, to keep the share prices high, inflated profits by fraudulently capitalizing operating expenses. The fees paid for using other networks were classified as capital expenditure instead of as regular operating expenses. Treating a cost as an asset allows it to be spread over many years through depreciation, making the company appear more profitable in the current period. They also falsified the revenue by creating fake revenue entries in their books to close the gap between their true and reported financial performance. SEC found that WorldCom had inflated its assets by over $11 billion and misstated its earnings by billions of dollars between 1999 and 2002. The company's external auditors, the Pricewaterhouse, had failed to detect the massive fraud despite, WorldCom was Arthur Andersen. The vice president of Arthur Andersen, Mrs. Cynthia Cooper, the head of internal audit, acted as a whistleblower, leading to an investigation. WorldCom filed for bankruptcy. 30,000 employees lost their jobs, and the loss was estimated at $180 billion. Both the Enron and WorldCom collapse in the year 2002 shook investors' confidence in corporate integrity and in the financial market. The effect on the economy was a staggering $8 trillion. I'm talking about 2002. The role of Arthur Andersen, the auditor for both these organizations and considered the top audit firm of those days, came under intense scrutiny, leading to its eventual collapse. Similar frauds also took place in India. We may all be familiar with what happened in Satyam. Founded in 1987, it grew rapidly as a leading Indian IT company. It had 40,000 employees with a revenue of $2.1 billion. It became the first company in India to be listed in 3 international stock exchanges. However, beginning from 1999, manipulation of financial statements began. The objective of this manipulation was threefold: keep company share prices high, increase investor confidence, and boost market capitalization to attract more investors. The fraud began as a marginal gap between the company's actual operating profit and the numbers that appeared in the accounts books. However, the fraud grew to a staggering $1.47 billion. Between 2003 and 2008, the company created false clients, projects, and invoices to falsify company's financial performance and improve its profile in the IT sector. They had inflated financial statements, fabricated cash reserves, and created about 13,000 fake employees accounts to siphon off about 200 million rupees per month in falsified salaries. The owners diverted the money from Satyam's account to fund this family's real estate business. The company's external auditors, the Pricewaterhouse, failed to detect the massive fraud despite auditing the company for many years. Auditors relied on falsified information provided by Satyam's management and did not conduct independent verification. An anonymous whistleblower sent an email to an independent director detailing the fraud, which prompted an internal investigation. The impact of the fraud was that Satyam's share price plummeted, wiping out billions of dollars in the market value. Both investors and the employees incurred great losses. PACL, Pearl Agrotech Corporation Limited, even now the investigations are going on, was another scam that took place during this period. The company took money from investors claiming that land would be developed for agricultural and commercial purposes and sold at a significant profit from which investors will receive a very high return. However, instead of land ownership documents, investors received nothing more than receipts which held no value. It was a classic Ponzi scheme. They initially paid returns to earlier investors using the funds of new investors. Agents received significant commissions to recruit new investors. SEBI carried out investigations on receipt of numerous complaints. By the time SEBI intervened, 5.5 crore people had already been scammed. About 500 crore worth of property was found purchased in Australia by diverting these funds. NFRA in its investigations had found that PACL had mobilized public funds to the tune of 69,077 crores from investors during 1996-97 to 2014-15, of which rupees 24,152 crores was found as outstanding as on 31/3/2024. The auditor had certified a true and fair view on 20th August 2024 with 16 qualifications and 15 emphasis of matters. Investigations are still going on, and just last week there was a newspaper article which said that ED has attached immovable properties worth around 2,000 crores in PACL case. You are also familiar with DHFL case where about 11,000 crores were siphoned off by the promoters by fictitious branch and fictitious loans. There was a complete disconnect between the principal auditors and branch auditors. The various frauds that have taken place in India prompted the lawmakers and stakeholders to desire an independent regulator in India too, as in the model of other countries. The Companies Act 2013 provided for the National Financial Reporting Authority, which started functioning from the year 2018. India's path followed a similar crisis-driven trajectory. While we had seen scams like Harshad Mehta security scam in 1992, the Satyam Computer Service scam in 2008 was our Enron moment. Systematic manipulations went undetected for years, leading to intense criticism of the self-regulatory model and calls for an independent statutory regulator. The Parliamentary Standing Committee on Finance in 2010 and 2012 recommended institutionalizing a quasi-regulatory authority, which led to Section 132 of the Companies Act of 2013. Despite legislative backing, NFRA's operationalization was delayed until the Supreme Court's intervention in 2018 in that S. Kumar vs. ICAI matter and the PNB fraud. NFRA was finally notified in October 2018, marking a fundamental shift to a dual regulatory architecture where NFRA oversees public interest entities, PIEs, numbering about 7,000 companies, while the ICAI continues to regulate the remaining bulk of companies, with active companies registered with the Ministry of Corporate Affairs numbering about 12 lakhs. Thus now we have a two-tier regulatory system in the country. As an independent regulator, our role at NFRA is built on 4 pillars: setting standards, ensuring high quality codes and standards are in place, monitoring and inspections, carrying out financial reporting reviews and audit quality inspections to verify that individual audits follow laid down standards, disciplinary action, taking measures where malified intent or gross negligence is found. I'll cover about this later, maybe in the question answer session. Safeguarding trust, publishing inspection findings to offer insights for both auditors and audit committees. Our objective is not merely punitive. It is preventive and progressive. We view inspections as a practical learning tools to protect public interest. Let me tell you, there's a lot of general fear. I've been interacting with a lot of auditors because I'm also a CA. I have a lot of friends who are chartered accountants. There is a general fear about NFRA. Of course, I came into NFRA only last year, only by July of last year. This fear came because of NFRA's initial few orders, which were seen to be extremely harsh and extremely tough. But let me give you the background why, because I've been going through it very in detail. When NFRA was formed in 2018, at that point of time, a few cases like IL&FS, Coffee Cafe Day, some cases like that, which the investigators, by investigators I mean the CBI, the ED, the SEBI, SFIO, all of these have already concluded their findings, and the matter was referred at a much later stage to NFRA regarding the responsibility of auditors. As they were already completed cases, NFRA in the initial stages, of course every organization evolves, so NFRA in the initial stages, they went around looking at it from a different perspective, and those penalty orders were issued. You know, I retired as the secretary in the Central Vigilance Commission, after which I've been appointed as a full-time member in NFRA. The Central Vigilance Commission is the apex anti-corruption body in the country that supervises both the CBI and the ED. So during my years there, I had a lot of inner understanding into how these organizations function. Even the Central Vigilance Commission has evolved over the years. It was formed in the year 1964, again after a particular scam took place, I think, which I will not get into detail. But after it was formed in 1964, for the first 20 to 25 years, the CVC was only acting as a punitive organization. They were only punishing government employees across the length and breadth of the country, and became a very feared organization. But sometime in the late 80s, there was a change. From just punitive actions, CVC moved into what is called as preventive vigilance. They started leveraging technology, setting systems and procedures in place, basically going in for systemic improvements that will bring about institutions of integrity. So that was the aim of the CVC. And today, by the time I left CVC, we are very proud to say that CVC has got a very positive image in the country now, as not just a punitive organization, but a preventive and a participative organization. In the same way, even NFRA, when it began in 2018, the first few cases, maybe 50, 60, 70 cases came to us are already finished cases. And a post-mortem was done by NFRA, and those orders have been passed. But as days go by, now it is a new EB that has taken over now. We are now looking at it from a different lens. And it is not just punishing people only. We are interested in reaching out. That is why in the last 1 year, which I'll come in a subsequent slide, we have come out with outreach activities. We have come out with various circulars, audit tools, and so on. The aim is to create a financial ecosystem which will also include capacity building. In fact, just before this thing, one of our professionals sitting here told me that capacity building is very much required because small-time auditors, they do not have that capacity building. They do not have the means of having that capacity building. So NFRA wants how it can leverage and build capacity of small-time auditors, educate them as far as possible, maybe with the help of the ICAI and other means and all that, so that tomorrow we create empowered professionals who are interested. Because I strongly believe from experience in CVC, in any society, more than 90% of the people want to do what is good, what is right. They want to follow integrity and ethical principles. It is only around 5% bad apples are there in society also, in any profession also you have that percentage. But if these 5% people are not given exemplary punishment, and if systems and procedures are not created for the remaining 95% of the people who want to do good, then the whole system will go for a thing. So in NFRA, we understand this reality. Our disciplinary actions are directed only against that 5% who involve in malified intent. I'm sure all of you will agree. If somebody involves in malified action, they should be punished. But the 95% remaining people who might commit errors of judgment, or they might have an ignorance of rules, we want to take them out and want to create an ecosystem, maybe over the years, that will help them to perform their function with their heads held high and with confidence. So as an independent regulator, our role on NFRA, as one sees from section 132, NFRA's functions are ideally structured to cover all critical elements of high quality financial reporting framework, right from standard setting to monitoring compliance and finally disciplining the erring auditors. Overall, NFRA has adopted a mix of enforcement and supervisory approaches. It has maintained India's momentum towards convergence with IFRS accounting standards. It has spearheaded similar efforts in the area of auditing and quality management standards. In order to drive systemic improvements in audit quality, it has initiated many supervisory approach tools like firm-wide inspections, audit workshops, audit practice toolkits, advisories, and circulars. Okay, now let me give you a high-level overview of the focus areas in NFRA inspection, which are shown on the slide. In 2000, how we go about doing our inspections. In 2022, our inspections focused on quality control systems of audit firms, and for the individual engagements selected, we concentrated on 3 key areas: revenue, trade receivables, and investments. In 2023, while we continue to examine firms' quality control processes, our file reviews shifted towards internal controls over financial reporting, specifically in relation to revenue, related party transactions, and impairment of assets. In the current inspection cycle, which is now going on, we are inspecting about 10 firms and about 42 other audit engagements by these firms. We are again assessing firm quality control, but in addition, we are focusing on revenue, loans and advances, and one engagement-specific high-risk area for each audit selected for reviews. Now let me go to a few findings of NFRA over the last, almost 3 years from our thing. As we examine the major findings from the NFRA inspection, we must look at the roots of the problem, which lie in governance and independence failures. These are not merely administrative errors. They represent a breakdown in the fundamental framework that ensures an audit is objective and reliable. We have categorized these failures into 3 critical areas: independence breaches, leadership lapses, and client management issues. First, regarding independence requirements, the findings are quite stark. At the engagement level, we found that mandatory independence confirmations were either not obtained or not retained within the engagement management system, violating SQC 1. More significantly, there were direct violations of sections 141 and 144 of the Companies Act. These included the firm or its network entities providing prohibited non-audit services to auditee groups, which creates a severe self-review threat. We also found that the firm's internal policies were fundamentally flawed, as they incorrectly allowed for non-audit services to foreign holding companies and failed to align with India-specific statutory requirements. Next, we move to leadership responsibilities under SQC 1. The inspections revealed a significant lack of oversight at the highest level. For instance, there was no established board to oversee the network's activities as required by its own networking agreements. Furthermore, the firm failed to document its leadership structure or define responsibilities clearly. This vacuum in governance meant there was no formal rationale for how internal reviews were selected, nor was there any comprehensive documentation regarding the firm's management structure. When the tone at the top is undocumented or unmonitored, quality inevitably suffers. Basically, many of our findings were about the big 4 and big audit firms who are network entities and all that. Finally, the client management issues. A robust audit begins with knowing who you are working for. However, the firms failed to adhere to critical client acceptance and continuance perquisites. Specifically, there was a failure to properly verify client integrity and a lack of formal records showing how identified concerns were resolved. By skipping these vital gatekeeping steps, the firms expose themselves and the public to heightened risk before the actual audit work even begins. As we transition to the more technical aspects of the inspection, we use this leaking bucket visual to illustrate how audit quality is being drained by specific repeated deficiencies. Each leak represents a critical area where the standards were not met, ultimately weakening the entire audit opinion. These deficiencies span from risk assessment to the final reporting under CARO. Starting with risk and fraud, we observed a significant failure to reassess and recategorize audit risk during engagements as mandated by SA 315 and the firm's own manuals. There was also a recurring issue of inadequate documentation when attempting to rebut the presumptive fraud risk of revenue recognition under SA 240. Moving to communication, we found a fundamental misunderstanding of SA 260. In several cases, firms failed to correctly identify those charged with governance, often incorrectly limiting their communication solely to the audit committee. Another major area of concern is asset valuation, specifically regarding impairment under Ind AS 36. We found audit procedures to be highly deficient, with teams relying on outdated or unsigned letters of financial support instead of obtaining sufficient appropriate evidence for non-provisioning of losses. This ties directly into expert reliance under SA 620. Rather than performing an independent evaluation of the assumptions used by management or auditor firms place total blind reliance on their findings, essentially outsourcing their professional judgment. Finally, we look at the statutory compliance and CARO reporting regarding related party transactions. There was failures both in identification and SA 550 and in providing evidence that these transactions were conducted on an arm's length basis. Furthermore, we noted non-compliance with Section 186 of the Companies Act. This carried over into CARO 2016 reporting, where firms failed to meet the specific disclosure requirements of Section 186(4). Collectively, these leaks show that when technical standards are treated as optional or secondary, the overall quality of the audit simply cannot be sustained. Moving to our next critical area of concern, we examine how the very foundation of the audit, its documentation and procedural integrity, have been compromised. We use this gears analogy because audit quality relies on several moving parts working in perfect synchronization. When documentation fails, when EQCR is inadequate, or when consultations are unrecorded, the entire mechanism of professional accountability grinds to a halt. The first gear represents EQCR deficiencies. The second gear that we must address is documentation failures. And the final gear involves consultation gaps. Under SQC1, when a team consults on a complex matter, the basis and rationale for the final decision must be documented. However, our findings show that the firms frequently fail to record these critical decision-making paths. This is taken from IFR findings. Independent forum, International Forum of Independent Audit Regulators has been established, and 56 countries are members of that IFR. And India's NFRA also was admitted as a member in the year 2023 after a very rigorous process of vetting by the international body. And this IFR has come out with various findings on a global scale. And I've also established 14 high-level principles that audit regulators should follow in their respective countries. So from IFR, when you see at the current auditing landscape, a recurring question arises: why do today's audit report often lacks deep actionable insight? To answer this, we have to look beyond simple human error and identify the systemic root causes that undermine quality. As visualized in this slide, poor audit quality is generally the result of failures in 4 key pillars: mindset, resources, leadership, and processes. Starting with the mindset issue, quality begins with an individual's psychological approach to the task. We frequently see a lack of professional skepticism where management's representations are taken at face value without enough pushback. This is often compounded by a cut-corner attitude and unfortunate willingness to bypass complex procedures just to get the job done. If an engagement team is unwilling to learn from past mistakes, or if they begin to compromise their ethical values for the sake of convenience, the entire audit's integrity is compromised from the start. Regarding leadership, perhaps the most critical driver of quality, we often talk about tone at the top. If a firm's leadership consistently prioritizes profits and speed over the quality of work, then message filters down to every junior associate. When actions don't match words, meaning a firm's claim to value quality but doesn't implement policies to promote it, the audit culture also erodes. Capacity building and small firms. India has over 1 lakh CA firms, but more than 70% are small practices. These firms often struggle to invest in the technology and training needed to keep pace with digital audit practices. NFRA is committed to capacity building through webinars, interactions with local CA associations, and the launch of audit toolkits to reduce avoidable non-compliances. Technology and AI tools are now used extensively by corporates as well as large audit firms. I was recently in Washington for the PCAOB's conference. The major topic of discussion there was on the AI and its impact on the auditing profession. The conclusion after exhaustive deliberation was that AI is inevitable and auditing practices need to adjust itself to the changing scenarios. AI can be an effective tool to reduce time in processing, but we should not forget responsibility for the output remains with the user, whether auditors or regulators. I don't know as to how many of you are aware, but NFRA too is planning to use AI tools in its inspection and monitoring process. We, in partnership with MeitY, that is the Ministry of Electronics and IT, recently in January, last month, under the India AI, have launched the India AI Financial Reporting Compliance Challenge to solicit AI-powered solutions that help in monitoring financial reporting quality and speed up internal tasks. The initiative invites Indian companies and DPIIT-recognized startups to develop an advanced engine capable of extracting data from multi-format documents and validating them against frameworks. So participants will compete for a total prize pool of 1.5 crore rupees, with up to 10 teams receiving rupees 5 lakhs each during a virtual refinement stage, and one winner potentially securing a 2-year contract with NFRA worth up to rupees 1 crore for national scale development. In fact, the competition is still open and the last date is 22nd of February. The challenge seeks to produce explainable compliance validation reports, automated analytics for risk indicators, and an AI-enabled insight bot. Okay, now let me come to the budget of 2026. During the budget speech on February 1, 2026, that is day before yesterday, the finance minister stated, I propose to constitute a joint committee of Ministry of Corporate Affairs and the Central Board of Direct Taxes for incorporating the requirements of income computation and disclosure standards, ICDS, in the Indian accounting standards Ind AS itself. Separate accounting requirement based on ICDS will be done away with from the tax year 2027-28. I don't know how many of you noticed the statement of the Prime Minister. To briefly touch upon, the income computation and disclosure standards ICDS were introduced in the year 2015 to create certainty in the computation of taxable income. Currently, there are 10 notified standards that apply to all taxpayers except individuals and HUFs not subject to tax audit, following the mercantile system of accounting. ICDS largely pertain to areas like accounting policies, revenue recognition, and fixed assets. These standards are primarily tax calculations and do not govern the maintenance of books of accounts. Crucially, the Income Tax Act prevails in any instance of inconsistency between the Act and the ICDS. The journey towards streamlining began on February 14, 2025 with the constitution of the Select Committee of the Lok Sabha, chaired by Sri Baijanath Panda. The committee was tasked with examining the Income Tax Bill 2025, which is set to replace the 1961 Act. During a presentation before the Select Committee in April of 2025, the National Financial Reporting Authority made a pivotal recommendation. NFRA proposed that maintaining two separate set of books, one for financial reporting Ind AS and another adjusted for tax ICDS, was creating compliance burden and leading to non-compliances. Thus, ICDS could be aligned with the Indian accounting standards, Ind AS and the accounting standards as applicable, and companies that are required to follow Ind AS may be permitted to follow the same for tax computation purposes with minimal differences as may be determined. On July 21, 2025, the Panda Committee submitted its monumental 4,584-page report recommending 285 changes to align the new bill with existing tax and accounting principles. So this budget announcement follows that, and by merging ICDS into Ind AS and scrapping separate tax accounting requirements starting from the 2027-28 tax year, the government has addressed a major hurdle. This is a key amendment that will erase compliance challenges with a positive impact on accounting and auditing professionals. So let me now conclude by briefly mentioning some of the potential takeaways for auditors. Independence of auditors. Evaluate the non-audit services provided by your firm and your network to ensure compliance with independence requirements and address any potential threats to audit independence, related party transactions, impairment of assets, integrity of audit documentation. Ensure audit documentation is adequately evidenced and demonstrates how you have challenged assumptions, reasoned through key areas and drawn appropriate conclusions. Then regarding professional skepticism, documents the extent of reliance on management explanations and key assumptions. Ensure you have raised sufficient questions and documentate your evaluation process to support your conclusions. And finally, on revenue recognition, implement robust audit procedures to ensure revenue is correctly recognized in accordance with applicable accounting standards with documented evidence of your verification procedures. Of late, the audit landscape is shifting from mere compliance to audit quality and professional judgment. Several key changes are currently redefining our profession. Integrated corporate governance. Under SEBI's LODR, audit committees now have direct oversight of external auditors. NFRA's recent circular on 7 January 2026 mandates formal communication between auditors and those charged with governance, TCWG, requiring at least 2 meetings per year and documented dialogue on audit strategy and risks. The evolution of standards, the convergence with the 2024 ISBA Code of Ethics and NOCLAR responding to non-compliance with laws and regulations, which will become effective on 1st April 2026, will transform the auditor from a financial validator into a guardian of transparency and will deeply strengthen public trust. Structural reporting reforms. The NFRA's recommendation of Ind AS 118 aligned with IFRS 18, presentation and disclosure in financial statements, which is set to replace the existing standard Indian accounting standard Ind AS 1. Presentation of financial statements aim to improve the clarity of financial statements and the presentation of the statement of profit and loss, shifting from mere compliance to meaningful communication. So thank you. As we move forward, we look to professional bodies like the ICAI as partners in this ecosystem. Depending on availability of time, I'll attempt to answer a few questions which you may have, especially about NFRA. Thank you.
I now invite CA Dr. Abhishek Murali, RCM SIRC of ICAI, to deliver the thank you note.
Very warm good afternoon to all. Thank you very much, Daniel sir. It's a pleasure to listen to you, and the way you presented was very wonderful, talking about the history of scams, of frauds, and then bringing it to today's scenario and what practical issues you are facing. As a chartered accountant, what I can say is, when we read about NFRA, more often than not, the media always shares what the bureaucrats say, the past IAS people who don't have a CA background. So when a person like you comes and addresses, it really allays the fears, knowing that one of our persons from our own profession is there. So definitely you will uphold, because we all know when a person who's charged with governance wants to cover up a scam, they have the great efforts, they will go into great depths to do it. Sometimes it may be difficult for a chartered accountant in many cases to find. Yes, you should definitely do it. But the truth that you must be a watchdog, not a bloodhound. Sometimes that lines are getting blurred. But knowing that we have an expert like you, our own professional, definitely gives us a lot of comfort, especially a lot of the aspects that you touched on today, even the questions that our members asked. It's a lot of fear that we have. But one thing definitely we always keep in mind is that our own CA Institute has a very robust disciplinary process, and the NFRA takes up higher level cases or specific cases, but even the institute has a very effective disciplinary process where even frivolous complaints are not entertained. They find them prima facie guilty, and then only the process takes. So you will ensure that a person who is genuinely affected, so we need not fear about frivolous actions being taken, and our institute is working very hard. The disposal of the cases are very high. So I'm very sure that working hand in hand with NFRA is what will happen in the future, rather than working in silos. And we always say we must bend without breaking, but also we must be flexible enough to understand the practical challenges of a CA. So thank you, sir, for spending your time and giving your insights. It's really, really a wonderful session. Thank you all members for actively participating in the same, and wish you a happy lunch now. Thank you. Very good afternoon to one and all. I had the pleasure of introducing the speaker, but before that I had to share a few words. Because when I listened to Haribhakti sir's speech, the few members had discussed certain points with me. When it comes to this union budget, we had a meeting yesterday also at Rani Site Hall. Many of you were there. The question is, how effective was the budget? So a lot of jargons are thrown around. It's a structural budget, shaping budget. Ultimately, what does it matter? They said it's going to reduce litigation. If you remove the right of appeal, obviously litigation will fall. You put a penalty fee instead of penalty, you put a fee. You can't challenge it, whatever reason it may be. If you want to file a tax audit report within the due date, if you didn't file it, it's not an automatic penalty. You'll get a show cause notice. You can prove the reason why you have not filed, why there's a delay. Maybe a delay of 1 day, maybe a delay of 3 months. What's the reason? Assessee died. Assessee's mother died. Really, we handled a case where the assessee was a company. The co-director of the company is the assessee's mother, who used to take care of the administrative affairs. He used to do the marketing. Assessee's mother passed away suddenly, and he went into depression. He didn't know what to do also. So audit report not filed. There's a 3-month delay. When the notice came after the assessment is completed, we had to just give the death certificate and show it. There are cases where the auditors themselves have died. Where's the question of filing the audit report? So when you say that if you don't file the audit report, we will put a fee and not a penalty, it's highly unfair. This entire budget has so many moves. In fact, I said this yesterday as well. The 2025 budget was an amazing budget. So many benefits. Increased rebate, increased slab rates. They didn't touch the old tax regime, but that's okay. This new tax regime has been incentivized substantially. So going into this budget, I had rock bottom expectations because they have given a lot. So much you have given, so much you have sacrificed, so much foregoing. So yes, I cannot be greedy and expect more. But despite having low expectations, they managed to disappoint me. Where furthermore, so many changes. Part B had ridiculous number of changes, and I should very, very frankly say, majority of the changes in my personal view are highly disappointing. Retrospective amendments, unfair amendments, sovereign gold bonds. Sovereign gold bonds is a great scheme introduced by the government, where you purchase the gold bond and you get an 8-year maturity. After that 8 years, the entire gains that you're getting from it is tax-free. The entire gains is tax-free. It's a very attractive scheme. And they also said, after 5 years, the lock-in period ends. If you want, you can sell it, provided you have to pay capital gains on it. Whoever buys it from you in that secondary market, they will get the exemption, whatever you will get on the attainment of the 8 years. Now what the government said, the exemption if you purchase from secondary market has been removed. That was not our intention. What nonsense. What happens to the people who purchased it? Under the bona fide belief they are going to get the exemption. Who is there to protect them? You will just make an announcement. And yesterday when I said this, somebody said, sir, it is prospective. It can't be prospective because there is no more SGB issues at all. Yeah, it's impossible. So then someone said, they said you knew that secondary market. Why? Sir, if secondary market it is not there, who will buy it at all? Where is the market itself secondary? I am not a fool to buy a sovereign gold bond when I can buy gold ETF or physical gold also. Why I should go and buy if not for the exemption? Yes. Where is the need for the amendment? The amendment has come for one reason. Gold prices have gone up, government is affected by it. Hopefully, they don't later say our original intention was never to give exemption. Even people who subscribe first also don't get. So these kind of amendments are highly unfair. JAO, FAO issues are there. DIN number. I played the video also yesterday. DIN number. If DIN is not there, the order you can throw it in the bin. That was what was said. I played that video. And then it is said, our intention was not there. If DIN is not there, it's okay. You take it as okay. Then by mistake, I tore the notice and threw it. You only told me to do it. I should have thrown that speech only. But this is the factual thing which has happened in this budget. So in my view, when you say it's a landmark budget, it is landmark, but for all the wrong reasons. This budget has far-reaching repercussions in my view. And we have two speakers with us. One will be covering direct taxes, one will be covering indirect taxes. Indirect taxes, I think many good things are there. Few good things are there in direct taxes, but majority in my view is definitely more on the not so good side, or if you are being frank, on the bad side. So it's something which is very important to discuss. It's important to understand in a frank manner. Not saying it's jargons like it's structurally good, it's going to shape the future of India. In the long run, it will benefit. In the long run, I'll be dead. Today, what is the impact for me? So that is the most critical thing for us to understand. And we have with us Mr. Rohit Jain, Deputy Managing Partner of Tax and Custom and Allied Laws of Economic Law Practice. He heads the tax practice of the firm, which focuses on indirect taxes, direct taxes, transfer pricing, and customs. His expertise prior to introduction of GST is customs, service tax, central sales tax, and VAT. He has been with the firm since its inception and has over 2 decades of experience in handling matters related to tax. And he also does litigation. He's advised various Fortune 500 companies, including financial services, manufacturing, telecommunication, oil and gas, petroleum, etc. He is a member of TaxSand Network and is regularly invited to speak on various tax and foreign trade policy issues. He has been recognized by several publications, more recently Elite Practitioner for Tax, Leading Partner for Tax, recognized as Tax Lawyer of the Year by ITR Awards, Tax Litigation Star, ranked among the top 100 lawyers in India by the Forbes Legal Power List, and many others. So he hails from Bombay. Thank you very much, Rohit ji, for joining us today. We're really looking forward to the session. Please give him a huge round of applause.
Thank you, sir. I request Dr. C. Abhishek Murali, RCM SIRC of IC, to adorn the shawl and hand over the memento to our speaker, C. Advocate Rohit Jain.
Thus, I'll be taking my leave because I have a program at the Chengalpet branch on the analysis of union budget. So please excuse me. Of course, we have other organizers, our staff and team is there, and others are also there to help out. So wishing you a wonderful session. Thank you.
Thank you. We will now move to the technical session. Over to you, sir.
Good afternoon, and thank you SIRC for inviting me for this session. Thank you Ravi sir for being behind me to come to Chennai and speak on this topic today. when we were talking with Revati also, I think she also left, that what is there to speak on indirect tax? We have gone on those old days where the budget used to contain so many amendments on indirect tax, be it excise, service tax, customs, some Central Sales Tax Act, and so on and so forth. Now we have reached to a stage where every GST Council meeting is a mini budget. So we see so many amendments happening in a GST Council meeting. And the customs is the only area which is left, which is effectively covered under the budget. But having said that, they all have requested that whatever are the amendments, please cover that. But also cover on a topic which is very, very critical in today's day and age, is the litigation trends and the strategies. So what we will cover in next 45 minutes or so is a topic on what are the budget announcements in indirect tax laws, and also cover on certain litigation trends that we see and observe, along with some of the strategies that we all really need to employ in terms of how we manage the litigation. Abhishek already set the tone for the budget in terms of what is this budget all about, and most of the things that he spoke about is all about the direct tax. I'm sure Vishal will cover all of such amendments, good, bad, ugly, all of this, and he will touch upon all of these in detail. But what I intend to cover is the key legislative changes first under the GST law. One of the biggest change that we have had in terms of GST Council meeting proposed on a 56th Council meeting, that we need to amend Section 15 of the GST law. What was the need for amendment of Section 15? Section 15, which all you know, is the valuation provision. And we have then Section 34, which in turn allows the assessee to issue a credit note. Now, credit note was allowed to be issued only for limited purpose, that if you had charged the excess value or there was some deficiency in supply of goods or services. And Section 15 was also giving us a deduction in the value for the discount element. But there was a condition that you are allowed to claim a deduction from the value qua discount only if it is prior intimated to your customer, the recipient. And of course, there are other conditions, that you effectively issue a credit note within the stated time frame that you have got. And third, your recipient reverses the ITC. So there are one important condition which existed, that you have to intimate the discount structure prior to supply of goods or services. And this was posing a lot of litigation, that where did I really need to intimate? Is the email correspondence is good enough? I have verbally communicated before supply, would that be a good enough? I have had a program which is run by my sales executives or marketing executives, and they communicated to the dealer and distributor, would that also be good enough? What is the nature and form of communication that I need to have to give back to my recipient? And this was creating a lot of issues and disputes. Finally, the wisdom prevailed. They have omitted this condition of a prior information and intimation. Now there exist only two conditions. One, that there is a issuance of credit note. And as you know, credit note is required to be issued within the stated time frame after end of the year, which is before September of that next year. So one, you issue the credit note, and second, that recipient reverses the ITC. So the second part of the condition still exists, that if you want to reduce the value from the supply of goods or services and claim a reduction, you have to issue a credit note, and second, you also need to effectively ensure that your recipient has reverses the ITC. I feel it is logical but extremely difficult to implement. Why logical? Because if you have raised original invoice and it is credit already taken by recipient, You are again claiming a deduction on account of discount. Without the credit being reversed by the recipient, it will tend to amount to tax being not gone to a treasury, but still credit is availed by somebody else. Having said that, the implementation part is extremely difficult because you as a supplier needs to ensure that it is actually reverts the ITC in the hands of recipient. So this is the dual condition you have to still meet with to come with this revised section 15 in terms of deduction. However, the core issue according to us is what constitutes discount. We have an extremely important circular issued in the month of September, which is 12th September 2025. Kindly note this circular because this is a circular which has been issued clarifying what constitute discount. And they have covered different types of transaction in a discount. First is a post-sale reduction is a discount when it is pure price adjustment on a principal to principal basis. So effectively I have sold the goods. When I have sold the goods and thereafter I have agreed to give a quantity discounts because you have lifted that much of quantity, or I have agreed to give you a cash discount if you make the payment within 20 days or 30 days. All of these are clearly a agreed discount on a principal to principal basis is a discount. Second, general dealer promotional scheme is also a discount. Extremely important because we now see any festivities, stock clearances sale, whether it's for automobile, whether it is for mobile phones, whether it is for white goods, you would always see that the brands are running the different schemes for a stock clearances, right? When it comes to festivities, the goods are already lying with the distributor. The goods have been supplied by the supplier originally. How will you treat this sort of a after supply discounts for a sort of a stock clearances scheme, any promotional schemes? Circular says that's also a discount. Very, very important because even if you are running that scheme post supply, circular clarifies it is also a discount. The problem is the third box, where if the dealer is under specific promotional marketing support services under an agreement with defined consideration, it will not be a discount. It is a different supply of service by the dealer to the brand owner or to the main original OEMs. Please understand, this is a transaction which is always susceptible to lot of area of interpretation and dispute, where if a dealer distributor is doing certain specific marketing activities for a consideration under a different set of agreement, then you can't treat this sort of a transaction as a discount from OEM and give that as a discount and issue a credit note. That will create a problem. And the last one, inducement versus discount. Any inducement, any pricing promotional schemes is also a discount. So there are different types of transactions already got clarified by way of a circular of September 2025, where we have to adhere to, now read with this amendment which is proposed in section 15 and section 34. It is extremely important to characterize what constitute a discount for the purpose of adjustment. So this is the first amendment. Second amendment is the intermediary services. We know the intermediary services is a concept where effectively, for want of better word, is the commission agent. Those who are promotional marketing services, those who are facilitating the supply of goods or services are considered to be an intermediary. And we had a provision under section 13 that for an intermediary, the place of supply is in India. So what is the consequence of that? That if the place of supply is in India, all those commission entities, those who are working for a foreign principal, even though they are getting this in a foreign exchange, even though they are invoicing to the party outside India, even though their recipient is located outside India, even though that they are effectively declaring for all other FEMA and other purposes receipt of foreign exchange as if export, still for the purpose of GST, it was not considered as export. It was liable to GST in India. It has created lot of issues, disputes, but most importantly, double taxation. Because on the import of goods, this commission is already included for the purpose of payment of customs duty, which includes IGST, and you are still charging on commission another IGST. So it had got into a double taxations. Lot of representations have been made, and finally they have decided in the 56 GST Council meeting that this intermediary will not be liable to tax, or in fact it will be treated as export if your recipient is outside India. So we gone back to a default rule of export being recipient outside India, and this is now been effectuated. Extremely important amendment, and this has again lead to a lot of litigation. Hopefully we'll get to the reduction of that. Another very quick procedural amendment, where we have had a provision 2 years back that there will be a national anti-profiteering appellate authority, so that all those areas where Tamil Nadu state is giving one ruling, Maharashtra is giving other ruling on the same topic, Kolkata, West Bengal is going another view, where the SSC goes to arrive at a common view, there was a proposal that we will form a national anti-profiteering appellate authority. It was there in the statute books for 2 years, but they could not form that institution. Now they have got the power that any of the officer or any of the institution like a tribunal, unfortunately GST tribunal also is got formed after 8 years of implementation of GST. But even after that, any of that tribunal could be considered as a NAAA authority for the purpose of appellate if you have a different views that you have got across different states. It can be challenged in that registered authority. Then one refund of tax issue, which is now as soon as you apply for refund, you would get provisional release of 90% of the refund. This was only possible for export of services refund. This facilitation was not available for inverted duty structure refund. Now they have also made that facilitation of 90% of the refund will get processed even for inverted duty structure refund, and this is also an important amendment as far as refund is concerned. Quickly on the customs changes. As far as customs are concerned, there are 3 big important changes, and there are not so big as there are in fact some of the disappointment as we've seen in terms of custom changes. First, voluntary payment under section 28(5) is recast as a charge and not a penalty. As Abhishek was saying, that instead of as soon as the investigation happens, prior to issuance of show cause notice under section 28(1) or 28(4), if you decide to make the payment along with the 15% penalty, you will get that matter to be treated as closed and you will not be issued the show cause notice. That was the provision. But that was called as a 15% penalty. Now they are recharacterizing this as a penalty as a charge. Now what is the rationale for this? Please understand, it is not that because they wanted to collect and reduce the litigation. Actually the rationale for this is, you as a chartered accountant, as an auditor, as soon as there is any imposition of penalty, we all know it requires a certain sort of declarations. It requires certain sort of disclosures to the regulators, not only in India, even to the globally. Even if I remember a matter, and used to be a sales tax in case of a drilling, a Gujarat sales tax authorities imposed the penalty of 2,000 rupees. 2,000 rupees on one of the foreign entity operating out of Europe. Clients made me travel to Gujarat 5 times to convince the officer to drop that 2000 rupees penalty. They paid me a fee of almost 4.5 lakhs rupees to get that penalty dropped of 2000. Because in their accounts, they can't have any amount being paid as a penalty. To avoid that, they have made this change as a charge. Therefore, they can't call this as a penalty, and hopefully none of these disclosures will not be required to be done. We have now Customs Advanced Ruling Authority validity period extended from 3 years to 5 years. We have now warehouse to warehouse transfer can be in a simplified way, that now the goods can be transferred from one warehouse to other warehouse. And we have got the AEO 2 and AEO 3 also got the benefit of a deferred payment of customs duty up to 30 days if you have a recognized AEO 2 and AEO 3. Very, very important amendments as far as customs are concerned. Then there are a lot of trade facilitation measures that they have done, that trusted trade facilitation. There is automated digital customs, single clearances, then AI based. And I will talk about AI based, how this is playing an extremely important role now in the course of investigation when I get to the investigation slides. Then warehousing simplification procedure. There is a passenger baggage rules have been completely changed overall. And now they are giving some other facilitation, something which you can bring it as a passenger baggage. I am sure this is not induced with the Netflix series which has come through that Tuskari, and this is exactly which is shown here and now been changed in terms of the passenger baggage rules completely overall, which has happened now. So this is in terms of the customs changes. What is the unfinished agenda in terms of budget in the indirect tax? Unfortunately, which we all know, the immovable property related ITC, there has been no amendment. We had the Safari retreat which has gone back. There have been retrospective amendment. No change, no credit is available. No notification on 11A. No clarity on taxation on the real estate transaction. Real estate transaction is one set of business or a sector is so adversely impacted because of GST, because it is one set of sector where the transaction in an immovable property being taxed as if it's a supply of goods or services. So that's a big impact, but unfortunately we don't see any discussion. No discussion on the petroleum products to get covered under the GST regime. No discussion on the inverted duty formulas for the structure services refund. And unfortunately, one which was highly spoken is the customs amnesty scheme has not been announced. We had excise amnesty, we had service tax amnesty, we had a GST amnesty scheme up to 2020. Hopefully that will get further extended in the next council meeting. And industry was looking forward for a customs amnesty scheme, but it did not come through. And therefore we believe that remain as an unfinished agenda. Now let's get to my next topic, which is the tax litigation trends and strategies. This has nothing to do with the budget, but there are a lot of things that we all need to be aware of and need to be really looking at how one should tackle these aggressive tax litigations. Just to give you some numbers, okay? Almost 25 lakhs pending tax matters at various forums in the country. 25 lakhs. No, total tax laws. Even total 25 lakhs pending matters. 70 to 80,000 tax appeals filed annually. 58% of corporate tax and 36% of income tax under dispute. 33% tax dispute takes 10 to 15 years of disposal. Annual litigation costs to economy ranges between $3 to $3.5 billion, and huge sum of money blocked in pre-deposits. You can imagine how much of tax litigation happening in our country. Once there was a joke, one huge matter going on, and whether it is interest or no interest and whatever, a lawyer make a comment saying that, Lordship, this happens only in our country, that lender needs to lend the money to a borrower and explain why he wants it back. So after judges thought, oh, wow, superb argument. After some time, judges said, but why are you upset, Mr. Lawyer? Because what we heard, there is a joke going on in the bar that at the end of the litigation, the lawyer becomes the lender. So this is what is our country's it. We have started ELP in the year 2001. And there was one big matter of EOU raid. EOU happened, DRI raided the premises. We got the show cause notice, adjudication, SESTAT, matter remanded, again SESTAT, finally landed in Supreme Court. 2024, we got an order from Supreme Court partially allowing appeal and partially matter remanded back to adjudication. After 24 years, I was telling the clients, the director, it's an Indian promoter group, that you and me only remain same in the matter. Everybody has changed. That is the state of litigation in our country when it comes to a tax litigation. And if you look at it, the tax litigation, how is this litigation happening today and why is this rising trends which we have all need to really notify? I'll tell you, I was talking with one very, very senior CA and a professional. He said, Rohit, beta, we used to prepare 2 balance sheets and profit and loss account, one for sales tax and one for income tax. All that we lived in our country, right? So the turnover for sales tax was say 20 crores and turnover for income tax could be 10 crores. It could be anything, right? But now all of this have gone a significant change. So what is happening today? How is the litigation happening in our country when it comes to a tax laws? And I just wanted to give few or 5 trends today. First, which is a simple, which is discrepancy in your returns, and they have deployed artificial intelligence tools. What do you think, that we have a much better artificial intelligence tools? No question. I was in DGGST office in Delhi, and one of the big client has got the notice for inquiry, and they were giving me the data that they have analyzed is at a different level. Your August purchases was this much versus August sales was this much, whereas your services that you have procured this much. When we compare this with August 25, it was different. When we compare this with November data, it is different. Explain why. The tools that they are deploying is far superior than we all have been deploying together. Second, the artificial intelligence tools is not only stopping for gathering the data. I always tell all of my clients that they are preparing virtually real-time basis your balance sheet and profit and loss account. Every transaction is mapped in the GSTN network today. So that is the first starting point of litigation of the data mining that they are doing. Second, information from other tax and regulatory authorities. We believe that, income tax information is available only with income tax, and the customs information is only with customs. Absolutely incorrect. It is all the tax authorities are sharing the information amongst them very regularly. But it is not only the tax, it is other regulatory authorities are also sharing the information. We had a big litigation on the customs side where the Directors Control of Drug Administrator, they have issued the notices to customs authorities that these goods have been imported by these an importer where the license got expired in the month of Jan 25, but we see they are still importing goods in the month of February 25. Please examine. I'll tell you one of the classic case of a transfer pricing and the customs. We know that we had this issue of brand royalty and brand and marketing fee on a transfer pricing. And brand and marketing fee on a transfer pricing, it was supposed to be charged back the bright line test and international transaction and so on and so forth. One of the auto giant happens to be having a big manufacturing facility in your state and in fact your city, Chennai. They made a beautiful argument in the tribunal ITAT saying that in terms of the OECD guideline, if I'm importing the component, I'm manufacturing the car, or I'm importing CBU, manufacturing the car, and if I'm acting as a limited risk distributor and making an arm's length margin, that means the import price is adjusted effectively even to compensate me for the brand promotion or marketing spend that we have got. If that be the case, I don't need to separately charge. Income Tax Appellate Tribunal issued a positive order and dropped the entire demand of income tax of a transfer pricing adjustment and dropped the demand of 53 crore rupees on the client. Within a span of 48 hours of the tribunal order being reported, Customs Authorities DRI came in that this is your submission, that price is adjusted on account of brand royalty and therefore this is undervaluation of the components and parts for the customs duty. Here is the demand of 237 crore rupees of a show cause notice based on your own submission. You think they are not talking with each other? You think that they are not mapping your submissions that you are making in one tax purpose or one regulator purpose versus the other regulator? The point which I am trying to make is, please examine cohesively the entire point when we advise clients on the tax matters. Will it have any other regulatory impact? Or also ask, when somebody comes to you with the tax notice, please get me all your regulatory filing, what you have been saying there, before I could advise on the tax matter. That's a second trend. Third, which is specific intelligence qua companies. This is, of course, was easy earlier, was not easy earlier, now became easy. One entity issued fake invoicing for supply of services. Their Dadaji and their Pota, everybody is tracked. Who has issued first invoice, who has issued second invoice, who has issued third, who has eventually taken a credit, who has a real supply, not supply. Everybody in the chain got the notices. It's a matter of fake invoicing, GST credit reversal, please do it. They have got a specific intelligence of all of this data, everything. So when the authorities knock your door, don't misunderstand ever that they are coming to you with some phishing inquiry. They don't know about which transaction they want to investigate. Gone all those old days. They come with a specific information, with the specific transactions to be looked at it. And you have to be fully prepared for that. Next, industry-wide issues. You have seen the recent litigation trend. One company in the insurance sector gets a notice. Believe me, all 32 companies operating in India of insurance sector will get the notice on the same issue. Pharma companies got the notice on liquidated damages paid to foreign entity. Do you pay reverse charge GST or not? All pharma companies got the notices. Give us the list of damages, what you have paid for. One auto company gets the classification disputes, which we are doing on the Skoda Volkswagen matter, which is all high stake matter. Every auto company in the country is investigated. Are you importing part or a car in a CKD form? So what does it mean? That please be aware that how many players in an industry, what issues they are facing, we have to be extremely vigilant now. Oh, I don't want to share my company's data with anybody. Please don't share. But let's be knowledge sharing. This is the issue I am facing. This is the problem. This is what the tax authorities are asking, so that collectively as the issue, you all can tackle this as an industry-wide trend. Have you seen this sort of a trend earlier? Of course no. But look at it, how this is happening now. This is all I am talking about, the tax investigations and litigation. And last, a media reporting of any transactions. Whether it's a Vodafone transaction, or whether it's a Sanofi transaction, or whether it's any other global deal happening globally somewhere in US, in Spain, acquiring some entity in Italy, who has a subsidiary in India, that has been published in the front page of our newspaper. Tax authorities, have you deducted 2011 TDS? L&T Mindtree, whichever you look at it. And we have a Tiger Global now looking at us, right? Like a tiger. This is all the recent trends of tax litigation in our country. Why am I sharing and why am I spending 10 minutes on this? That this is all what we have to be aware of. We have to be completely prepared for all such adversarial, aggressive tax investigations and litigation in our country now. And this is just a trend. We will see so many of these things will be happening in near future. So much so that let's look at the authorities. In GST, we have such a long process, adjudicating appellate tribunal, High Court, Supreme Court. In income tax, we have returns, commissioner appeals, appellate tribunal, High Court, Supreme Court, and then in between FAO, JAO, in between 148 notice, 147, no 148, what is the scope of that, so on and so forth. Such a huge litigation. And when GST litigation started, there are 6 authorities are investigating, empowered. Your DRI, DGGST, Central Jurisdictional Authority, Central Audit Wing, State Jurisdictional Authority, State Audit Wing. Anybody can come and investigate you. Whether it is central or state, I always remember a joke there once. Of course, the father who is becoming a father and first time father. So he tells the nurse, don't tell my wife it's a boy or girl. I want to give her surprise. He said, okay. The nurse said, yes, sir. If it's a boy, say it's tomato. If it's a girl, say it's cucumber. Okay? So he, with that instruction, he sent the nurse inside the delivery room and it's get delivered, baby gets delivered. Unfortunately, of course, it's the twin. Nurse got completely confused. What do I do? And she came running. Sir, congratulations. Salad has come. One boy and one girl. So I always ask, whenever my client calls me up, sir, there is this investigation. I'll always ask, central or state? And they tell me salad. Both have come together. It is that level of jurisdictional power that they have got to look at and investigate any of these SSCs. So we have a lengthy journey here, right? Then we have another topic to talk about, the mandatory pre-deposit. Good part in income tax, this got reduced from 20 to 10%, but in GST continued to be 10 and 20, and I don't know, after tribunal it is at the discretion of the High Court and a Supreme Court. Huge deposit gets paid in the course of litigation. One, the journey is too long, and the second, the amounts which is blocked in the pre-deposit is the huge amount. We have to really look at it, monitor, therefore keeping in mind the pre-deposit impact also. At what stage should I knock the doors of High Court? What stage should I pay and litigate? What is that I need to really do? All of this play an extremely important strategy in terms of the litigation. So this is in terms of one of the impact point. Now comes to GST investigation or any tax investigation, and what is that we have to be really looking at it. Last few slides. There are four stages of investigation in tax. One, according to us, the first one is the internal preparedness. The second is handling investigation, the actual raid or actual investigation when the officers are sitting in our office or our client's office. How do we tackle those? Third, the legal strategy that one needs to evolve. And finally, do we have any scope for policy advocacy? These are the four broad stages of any litigation that we have to be really working upon. The first one is the internal preparedness. What do we believe as an internal preparedness purposes? First and the foremost is the ready state of data and its reviews and analysis. The data plays an extremely important role. What your contract speaks, whereas what you advise on a tax. I can tell you one, recently we have got a matter where GST guys are alleging it's a IT entity, a big one of the top entities. They are they are taking a contract directly from a client outside India to provide IT services. Their India entity taking a contract. But while billing it, their India entity is billing to their US entity, and US entity in turn billing it to a client. I said, okay. And then US entity has entered into some support services agreement of sales and marketing for providing that sales and marketing support for India. GST guys have got confused. Is India providing services to client directly? Then why are you raising invoice on your own entity in US? No. We are not. We are providing services to our own entity and our own entity is providing to a client. Then why did you enter into a contract? I said, okay, fine. In the contract it is written that I can provide the services to any of the associated enterprise. No problem. Then where is the question of sales and marketing services agreement? If your foreign company, your own subsidiary is rendering services directly to a client, then they are sales and marketing services to whom? The point which I am trying to make is, whatever tax position that we take, please align with your contractual language, invoicing methodology, the payment that has been made, how this has been accounted for. We will always find, as a law firm, we always find the language in the contract is so dampening, exactly opposite to what you have advised as a tax position. So first, foremost is your internal preparedness. Second, the operational aspects, which is all your processes, systems, your regulatory declarations, your other third-party declarations, and so on and so forth. And the last one, your external, if you want to seek any opinions, did you already obtain certain opinions, not only on tax, be it your regulatory compliance, be it your tax, and see to it that it is all aligned in terms of your data, so you have a proper transaction mapping done. That is what we call it, a internal preparedness. Next, how do we participate in an investigation? First, accuracy. We have to have a full and honest disclosure. That is what we call it accurate statements. Second, consistency. You will invariably see that the investigating officer will try and take a statement for 5 people. Purchase guy, finance guy, tax guy, your MD, your CFO, you are this, you are that. And eventually they will ask the questions in such a way that they are identifying the inconsistency in the statements made by various people. So the core issue here that we have to be preparing and saying that I will be consistent in my stating the facts. Therefore, the person who is aware of should be recording a statement. Other person should only see I am not aware of. It does not matter in saying so many words. So consistency. Then timing. You can't just keep on asking, I will give you after 2 weeks. I will give you after 4 weeks. You can't just delay the giving the data. You have to time it right. That is the timing. And last, retraction. If for some reason you have stated something which you want to retract, be on timely basis, retract the statement. You have all the legal right to retract your own statement if it is not been accurately narrated something which has actually occurred in terms of facts. Extremely important that you have to retract timely your statements. Last, investigation don'ts and do's. Very, very important. We should have a cohesive briefing. The person who is giving a statement. Always act in a cooperative manner. We had one case, unfortunately, again part of your state. One person got very aggressive with the DRI. Go, what you want to do, you can do it. I have done everything right. Unfortunately, they took him and put it behind the bars. It took us almost 31 days to take him out of the bar. It is a problem. You have to act in a cooperative way. Seek time if unaware of the issues to the best of knowledge. Ensure statements do not lead to concern with the other statutes or regulation. Ensure that. And last, request copy of Panchanamas and annexures which have been effectively drawn on that day. On the don't side, concealing identities or misrepresentation. Absolutely don't do. Then making false statement. Panicking before the officer. You don't need to panic. You know what the facts are. You know the tax position that you have taken. Why are you panicking? If you have a proper internal preparedness accurate, you don't need to panic at all, and neither your client needs to panic. Recording statement on a recently joined person. We have always seen the politics in the client's place. A new guy, iska record his statement. He joined 2 days back. What does he know? So his statement be recorded. Again, not a good sign to do. And agreeing with the officer, which is actually not a correct fact, necessary and purposefully participate. I think these are all these things, and there are alternatives to litigations that one needs to keep on evaluating. Whether it's a voluntary payment, is the settlement commission, should we go to a writ court, at what stage should I go to writ court and an appropriate time, and do we have an advance ruling that I can obtain to achieve a certainty in relation to this matter. What are the government measures that they have taken to reduce litigation? Of course, they have in the past came out with various amnesty schemes. They have come out with the prospective amendments. Their now monetary limit have been set for appeal to be filed. We have faceless assessment, and there are some industry-wide clarifications being issued from time to time by the government. So therefore, there are a lot of things that which are happening, but ultimately we have to work with our own intuition. We have to work with what I am doing is right, and now the substance over form is the mantra in any laws, be it income tax, be it transfer pricing, or be it GST. And always remember, substance over form is one smart kid. Nowadays, the Generation Z, right? They are extremely smart. So one day, one boy goes to his father and says, "My dear father, Ram as a god became a big man, or she became a god by following his father Dasharath. And the Prahlad became god by not following his father Hiranyakashipu. You are my father. What do I do, my dear father? Should I follow or not follow you?" So that father was also smart enough. He said, "Look, my son, in old days, when there was Sati Yuga, Ram followed Dasharath. When there was Treta Yuga, Prahlad didn't follow Hiranyakashipu. We are living in a Kali Yuga. If you are living in a Kali Yuga, it is always good for both of us to follow your mother." This is the form versus substance. We have to go to a substance. We have to follow what our internal intuition says. We have to adhere to a correct tax position to tackle this sort of investigations. It was pleasure talking with you this afternoon, and thank you very much once again.
Thank you, sir. Members, we now open the floor for Q&A session. So please feel free to share your queries.
Yeah, Mr. Rohit, myself Balasubramanian. Every day I am seeing at least minimum 5 to 7 High Court orders where either adjudication or order in original is getting either setting aside or being even quashed. Why the government or CBIC or GST, nobody is sensitive about it?
Ideally, yes, but they are not, because that's their job. I believe that some of these adjudication orders are getting set aside or on some technical grounds. Now we are having these issues of clubbing. Multiple years cannot be clubbed together. They have passed a common order and so on. Different view. What is the government officer do in that case? Should I follow Delhi High Court or should I follow other High Court's view? So that's the problem. So therefore, some cases it are genuine. Some cases are, of course, it's getting set aside on technical grounds, and it's part of the game, part of doing business in India.
Sir, regarding the credit note issue, when we issue a credit note, it is duly intimated through GSTR1. I mean, the B2B transaction. Now, where is the question of intimating him separately for USA? Because I got a notice saying that, of course, they were proposed to disallow that credit note, living around 1.6 crores. They are saying that you should ensure that the recipient has reversed the ITC. How can I ensure that? Is it possible?
See, nowadays, of course, now you have a technology GST and it is mapped. Whether they have taken, but what generally we do it is that they will reverse in their 3B and you get a certificate from their charter accountants that they have reversed this ITC. That would be a good steps taken to ensure that credit has been reversed. But eventually, if he has not reversed and he gave wrong declaration, then you cannot be as faulted. At least you have taken a step to comply with this requirement that the recipient has reversed the ITC.
No, taking such certificate is mandatory.
Taking certificate and getting a copy of his 3B if you can, that would be an advisable thing to ensure that the credit has been reversed. That's right, but it gets blocked, same.
Sir, in the case of credit note, if in the same month credit note is raised and a self-declaration is to be taken from the supplier that he has not availed the input credit. That self-declaration in the mail itself, is it enough or we have to take in a separate letterhead and is it a separate process or in the mail conversation itself?
It's a main, if you can get that backed up by in the same month, a separate letter, proper letter.
Okay.
And secondly, also his CA should certify that he has not taken the ITC of this invoice.
But the customer is telling a CA certificate is not necessary, self-declaration.
It's not necessary. Therefore, as a supplier, whatever prudent step that you can take, you should do. If he is denying, at least take the proper letter and communication from him.
Because original bills are also returned.
That's right. So, and also, one of the requirement is to make the payment, right?
Correct.
180 days may, if you are issuing in the same month credit note,
Yes.
then he is not making that payment. So in any event, he will not be entitled to ITC.
Yes.
So
in
all
that
of this
case-
will support.
Correct. Because in the same month it is reversed.
It is the same
Self-declaration
self-declaration from whom?
from that person.
Recipient, the same thing.
Yes. But the mail self-declaration, is it enough for separate letterhead and all this?
Separate letterhead, so much the better.
Okay. Thank you. And another one small question, sir. In the supply of liquor, it doesn't come under GST. Company is purchasing liquor for 10 lakhs. They have given a discount of 1 lakh. That discount they have paid by check to the company. So whether it is, it will attract, the discount will attract the GST, sir?
It's a discount.
Yes.
That you have to rely upon this 2025 circular.
But in their books, they are not writing as a discount and reducing their sales. They are treating it as a separate transaction.
That's their problem. That's their accounting problem. But it is a discount.
Yes. Okay.
Thank you. Thank you very much. It was pleasure speaking this afternoon. Thank you.
Thank you, sir. Thank you for sharing the indirect taxes update and your efforts in preparing us for the litigation matters. The insights provided will be valuable for us for effective representation. Thank you.
Actually look at the sovereign gold bond. What it said is that if I sell it in the open market, I will pay a capital gain. But if I redeem it with the RBI, the original issuer, then the capital gain on that redemption is tax exempt. What is being proposed, which is again from next year, that if I am not the original subscriber, somebody called A subscribed to the bond and I as B, I bought it from him on the open market and I waited and then I redeemed it with RBI. Then the capital gains exemption will not be available to me because I wasn't the original subscriber. I think that is what this seems to suggest. Seems to be a revenue garnering measure. Also maybe a reflection that gold prices have increased a lot. Why don't you contribute something to the government? But the possibility is that today we are on 3rd February. Between 3rd February and 31st March, if there is a window available to redeem it with RBI, that redemption is tax free. I do not know because RBI would redeem it at regular intervals. You can't just go every day and redeem it. But assuming you can go to RBI and redeem your gold bonds up to 31st March, then whatever gains you have earned is tax free and you can reinvest that money back into the sovereign gold bond. So effectively you take a cost step up and you don't pay a capital gains up to the escalation today. So this is a small window probably available where many people would redeem it, claim capital gains exemption because the law till 31st March has not changed, and then hopefully reinvest back, assuming the gold has not crashed. A small clarificatory change again happening from next year, and I'll not spend much time. But if you look at the current law, whether the property is under construction or it's occupied property, your total limit of taking an interest deduction is still up to 2 lakh rupees. In the new act, they had missed out on the under construction property cap. So they have brought the new act at parity with the current 1961 act, which means that even now under the new act, when you are making an interest payment, whether your property is under construction or it is not, your total cap per year will be restricted to 2 lakhs. So it is more aligning with the current provision. There are few exemptions for foreign companies. I'll very briefly touch upon it and I'll skip it. If there are any questions, we can take it up. But the first issue is that whenever foreign companies avail services from data centers in India, there is an exposure that the foreign company is said to have a taxable presence in India. Business connection combined with permanent establishment. And that is one of the reasons why sometimes foreign companies are a bit hesitant in hiring data centers, because they believe that whatever their foreign income, that could be subject to tax in India. What government is now coming up with the proposal is, subject to certain conditions, subject to certain schemes which they will notify, a foreign company will not be subject to tax in India for a period of 20 years, up to 2047, if they hire data centers in India. And this is more to give them comfort that you come, you do business in India, you can set up your own subsidiary which does the data center. The data center has to be under the control and operations of the Indian entity, be it their related party or a third party. But for 20 years, we will not subject your overseas income to tax, for which you use the data center. So again, a welcome provision. The next is more to do with Apple type scenarios. So companies like Apple, what they do is, when they have contract manufacturers, either in India or in Taiwan, they control the manufacturing process end to end. When they control the manufacturing process end to end, there is again a issue whether this manufacturing is deemed to be carried out by them and whether that creates a taxable presence for overseas profits of Apple in India. The government has said that for a period of 5 years, we will exempt the foreign company which has a contract manufacturer in India in a bonded customs framework, provided they control the total manufacturing process end to end. But I could think of only one company, which is Apple, which will benefit, because Apple was apparently facing some kind of a issue. So this is again to encourage manufacturing activity in India. And then there is another exemption to attract foreign skilled people to come and be domiciled in India. The scheme will have to be notified. But what happens is that today, if I am a foreigner, right, I might be an NRI or I might be a foreign citizen, I hesitate to become a resident in India, because if I become a resident in India, subject to the 2-year benefit of being not ordinary resident, my global income gets taxed in India. What the government is now telling many of these skilled people, that you come to India under a particular scheme, we will not touch your global income, your overseas income, for a period of 5 years. Of course, you will have to pay tax on your India income, but your overseas income will not be touched. Now, of course, the scheme will have to be announced and we'll have to analyze the scheme. A small change in terms of filing a revised return. Today, the revised return have to be filed by December. The law says, okay, now you can extend it up to March. And it makes sense, because effectively, sometimes our due date is October or November, depending on whether tax audit transfer pricing is applicable. And it looks slightly illogical that my original date ends in November and I have just 1 month to file a revised return. So obviously they have said you can now file it up to March. So maybe a small benefit in that sense. Also, they have expanded the scope of updated return. So what is an updated return? A return which you cannot file as a revised return, which means your timeline of filing a revised return has ended. The only way then to file a return is to file an updated return. And when you file an updated return, there are certain conditions. Whatever additional taxes are payable, you have to pay certain penal tax on that. 25%, 50%, 60%, 70%, depending on what is the period you are filing. What the government has done is, it has said that now you can even file a updated return for a loss, which means that if you have filed a loss return and you believe that by error you have taken an additional loss which could create a penalty exposure for you, you are now allowed to file an updated return and reduce that loss, which I think is a welcome change. It is also saying that you can now file an updated return even after a reassessment proceeding notice has been issued to you. The only condition is, whatever tax you would pay for filing an updated return, you have to pay an additional 10% tax, right? So this is like some kind of a mini penalty you pay and you move ahead per se. Makes life easier because it gives an option for a taxpayer to buy peace. One of the better things which the government is doing is that there are so many penalty sections, there are so many prosecution provisions. The government is effectively relooking at it, and it is saying that I am going to reduce the number of sections where prosecution gets initiated. I'm going to create a materiality threshold that if the amounts involved, for example, are up to 10 lakhs, then there is no question of prosecution. I'm going to reduce certain penalties grade wise. So I'm not going to get into section by section, but many sections in the old 1961 Act and in the new 25 Act are being changed to make the penalty and prosecution sections more rational, which I think is again a good case. These are some of the sections. I'll skip it. There are some changes in penalties, some very minor changes, For example, the penalty for failure to file a tax audit report was the lower of 0.5% of your sales or 1,50,000. Now they are removing that 0.5% and they are saying, okay, if the delay is up to 1 month, pay 75,000, a flat fee, otherwise pay 1,50,000 fee. So somebody mentioned, right, penalty is being replaced by a fee. So this is one example of, what the government is doing per se. Again, I'll skip some of these, sections. Let me come to the TDS and the TCS sections. I think some good changes which have been made. There is always a debate that if I'm making a payment for a manpower supply, is it subject to a 10% deduction under 194J or is it subject to a 2% deduction under 194C? At least from next year, the government has clarified that a manpower supply will be subject to a 1 or 2% deduction under the supply of work. How I wish they would have done it retroactively, but at least from next year, this issue is settled. There is another provision which they have brought in. So what happens is whenever one receives a claim under a motor accident, from a tribunal, the main amount of penalty is not subject to tax because that is not an income, it's a capital receipt. But frequently, because that penalty has come to you a bit late, there is an interest component. And today the tax officers are taking a view that interest component of whatever compensation you get from the motor claim tribunal is subject to tax. The government is now from next year confirming that we will not tax this, not from next year, sorry, from the current financial year, that we will not tax that interest. Also, there would not be any deduction on that interest, which I think is again a welcome provision. So few changes in the manner in which you obtain a nil withholding certificate. So basically what the changes are is that today if I have to apply for a nil withholding certificate or a lower withholding certificate, I have to apply it physically before a tax office. The government will now bring up a scheme whereby I will be able to apply it electronically. And hopefully subject to certain conditions, many of these certificates will be auto approved. So we'll have to wait and watch, but it looks to be an interesting scheme. Also, whenever I used to receive interest or dividend and I was below the taxable limit, I had to give a declaration to each of the payer that you do not deduct any tax because I am below the taxable limit. Here again the government is coming up with a very good system. Instead of filing multiple declaration with multiple companies, if those shares are listed shares, I can just file a single declaration with my depository, and the depository itself will make those declarations to the respective companies. I think that is likely to be effective October 26 because probably they'll prune up the system and the system is not ready yet. I think this will again benefit those small tax filers which are not subject to tax and had to file multiple declarations. I think one of the good announcements has been on the TCS. We all know that under the RBI LRS, one can remit out $250,000 every year. And the government had created a very high TCS for amounts exceeding 10 lakhs. So, if you are sending money out and it is not for education or medical purpose, then your TCS was 20%. And if it was for education and medical purpose, then the TCS was 5%. That 5% has come down to 2%. But if I am sending money out, not for education, not for medical, then unfortunately the 20% TCS remain as it is. And we know that TCS is not a cost, right? It is more a working capital issue and I will have to claim it in my tax return. Again, if I'm making a payment to a tour operator for an overseas tour package, then if the amounts were up to 10 lakhs, there was a TCS of 5%. And if the amounts were exceeding 10 lakhs, then the amounts were 20%. The good thing is that now both these percentages are reduced to 2%. So irrespective of the amount I make a payment to the tour operator, the TCS applicable is just 2%. I believe it's again a good thing. The purpose of a TCS is more to track some of these taxpayers, who are flying abroad. So I think this will be a better thing. Again, couple of other TCS like sale of scrap, etc., where it was 1%, they have increased it to 2%, but effectively they are making a uniform TCS of 2%. For example, sale of Tendu leaves, right? It was 5%, they have made it 2%. But effectively, if you look at it, they are trying to rationalize the TCS to a uniform rate of 2%. We spoke about some of these process for lower TDS certificates, so I'll maybe skip it. They have made one important change in the repeal and savings provisions. And I'll maybe give an example to bring home the point. If I have written off, let's say, one of my receivable, and I have claimed it as an expenditure, and tomorrow that customer pays me back, then I have to offer that income to tax under section 41. The manner in which the new act was worded and the repeal and savings section were worded, if I have written off my debtor or my customer in the old act and I received the money in the new act did not had clarificatory provisions to tax that income. I think they have noticed that lacuna. Now they will tax that income even in the new act. This is as far as the changes which are happening in repeal and savings, which I think are very, very logical per se. While the government has said that the 20% pre-deposit under Income Tax Act will now be reduced to 10%, there is a problem. Now the assessment order and the penalty order will be passed together. It will be a single order. And I think that is going to create a lot of challenges. And let me give an example. In the past, when an assessment order comes and I appeal against that assessment order to CIT appeal and thereafter to tribunal, I had an ability to keep the penalty provisions under abeyance. If a penalty show cause was not issued, I would write a letter saying that please keep your penalty proceedings under abeyance because I am fighting on merit. Your actual matter could take 2 years, 3 years, and assuming you lose, the tax officer would then issue a penalty order against which you will either fight it out or you will pay it out. So you get a 2-3 year breathing time for handling your penalty demand. But now if I'm a tax officer and the law says that sorry, you cannot have a separate penalty proceeding, you have to issue a single order where the assessment is made and also the penalty order is made. The chances are that I will levy a penalty today only, which means that you will actually have a much higher demand. You will have the normal assessment demand and you will have the penalty demand. And of course, they have reduced the pre-deposit to 10%, but my quantum has increased. And which I believe is not going to help, because no officer is going to be somebody who is not going to levy a penalty. Penalty most of the times are automatic, which are unfair. And of course, then you will be left to fight it out at a higher level, arguing as to why the penalty is not sustainable. So again, not a very, very healthy amendment which has been made. Certain retroactive changes which I'm sure many of you are aware. The DIN errors have been legitimized. Many courts said that if a document didn't have the correct DIN or DIN was missing from all pages or on the front page, then that order is invalid. It is otiose. You now have a provision which says that no, if there has been an omission or a commission of error in putting a DIN number, it will still lend validity to that order. The provision does not say that the DIN is not to be issued. DIN has to be generated. So an officer cannot not generate a DIN. But if the DIN is generated, but he has missed out quoting it, that order will not be deemed to be invalid merely because he has missed out. So of course this is retroactive October 2019. So all these litigations, all the positive High Court orders, I think they are going to go to the dustbin. Again, couple of other, retroactive order. The whole Zhao versus Fao controversy, that who has the power to issue a reassessment notice? Should the reassessment notice be issued by the jurisdictional assessing officer, or should it be issued by the faceless assessing officer? And basis the CBDT instruction and circular, our argument was that the jurisdictional assessing officer does not have the power to issue a reassessment notice, and therefore if a reassessment notice has been issued, that notice should be regarded as void ab initio. Again, what the government has done with retroactive effect from April 21, it has legitimized the issuance of a reassessment notice by the jurisdictional assessment officer. So that again is something, I think Mr. Raviji just showed me Supreme Court disposes of one batch of Zhao Fao cases, remits back to High Courts, Right, interesting. I believe that one of the reasons why our GDP is growing, because at least 10 basis point is attributable to these writ assessments and the fees being earned by lawyers and consultants, jokes apart. But I'm sure the jury is still out on this per se. Again, we had a very interesting provision in the context of, issuing what you call the DRP orders. So, and I'll give you one example, how we fought in one of the bank's case. Effectively, there was a transfer pricing order issued on the last date, 31st March. The provision said that the transfer pricing order has to be issued before 60 days. So our argument was that you can't count 31st March, you have to count 30th March as the last date. And you had a Madras High Court order also in favor, etc. And there were many High Courts, Bombay High Court, etc., giving support to that order. Retroactively, now the government has said that no, when we say before 60 days, it also includes the 60th day. So you don't have that technical argument left anymore. There were also certain challenges on whether once a DRP gives an order, whether the assessing officer gets an additional time to draft an final order, or would it get over-encompassed against the 153 time limit. Again, there were few judicial precedents saying that no, the assessing officer has to be within the total limit. And again, there is a retroactive amendment which saying that no, we are giving an additional time to the assessing officer. I think what the government is doing is that don't play technical games, with us, We will go and we will change it retroactively. You please focus on the substance of the matter, which is said, These are some amendments which I was mentioning. So now there are specific dates depending on whether it's a leap year or not, given. I'll just skip that in that sense. Some interesting changes on the transfer pricing. The safe harbor provision for IT sector has been made much better. So earlier what used to happen is that depending on which subsector you are in, are you an R&D unit, are you a KPO, are you a software coding, there were different safe harbor margins ranging from 17% to 24%. The government says that let's club everything in a single head, which is IT. And second, I will eliminate this 17 to 24%. Effectively, 15.5% margin is good enough. So if you are within 15.5% margin, that's it, right? There won't be any transfer pricing addition. I think it's a great move. Also, earlier, only transactions up to 300 crore could be covered. They have now increased that to 2000 crore, which means many large companies will also get covered under it. And I believe Chennai is one of the market for SaaS companies. This could be, I would say, very, very relevant for many taxpayers in this city. The second good thing they have done it is that earlier, if I want to opt for a safe harbor, I had to apply to the tax officer before the due date of filing the tax return, and then the tax officer would act on it. They have announced that going forward, you can apply to a system, right? So it will all be electronic. My choice of a safe harbor will now be electronic. And of course, I'm sure they'll come up with the relevant systems, which again makes things pretty easier. You don't have to interface with an officer to make him agree on the safe harbor. Also, all the data centers which are now hopefully being encouraged to be brought into India, they are talking about a 15% safe harbor. I don't think ever the government was comfortable with a 15% safe margin. Normally it would be 18, 20, 22%, and therefore a 15% safe margin for a data center is, I would say, very, very good per se. APAs will have to be fast tracked. So if you are a IT sector company, you want advanced pricing agreement, the government has said that we promise to complete in 2 years, at the most a 6 months adjournment. And I can tell you, none of the APAs in the world have a time limit. We might be probably one of the first countries or one of the first few countries where we are committing a time limit for an APA, because the process itself is complicated. So I think it's again a good move for the IT sector, because again this is applicable only for the IT service companies. Foreign assets of small taxpayers disclosure scheme. I think you were all aware that after 2018 the Black Money Act came. Conceptually the act said that if you are a resident, you have to disclose all your foreign assets and you have to offer all your foreign income to tax. If you have missed out, then there could be penalty, there could be prosecution. Sometimes you miss out on disclosing a bank account, right? And the taxpayer would jokingly say that it has to be my CA who missed out, who should be put behind bars, not me, because that's not my error. So what the government has done is it has come up with a mini disclosure scheme. So if there are small non-compliances, the government says that I'll come up with a scheme, you please regularize it. And I'll just put a table on this. 2 categories. One where you have missed out on only declaring the asset. There is no income evasion. And those assets were bought either with overseas funds or they were bought from funds from income on which you have paid tax in India. So it's not that there is any income tax left to be paid, but you have missed out on disclosing the foreign asset. As long as the total value of your foreign asset is not exceeding 5 crore, you can regularize this non-disclosure with a simple payment of 1 lakh rupee as a fee. That's it. The second category, which is actually the first one in my table, on all other aspects, where the total value of the asset and income does not exceed 1 crore. So you have missed out on some asset, you have missed out on some income to be offered to tax. The total does not exceed 1 crore. You pay a 30% plus an additional 30%, which means a 60% fine on the income, and that's it. And you are not subject to any prosecution. I think they are trying to clear up many small cases of small skipping of disclosures of assets and income. I think all in all, it's a good scheme which the government is bringing. There is also, an exception where you may not be able to enter that scheme. For example, you have been charged under money laundering, right? Then irrespective of the value of assets, you cannot be part of that scheme. So they've created some exceptions, but more or less the schemes seem to be very simple and broad based. There is also one specific amendment which has happened under the Black Money Act, and that amendment was as under. Couple of years back, the government made a provision that if you miss out disclosing any asset below 20 lakhs, then we will not initiate any prosecution, we will not initiate any penalty. But they missed out on adding that in addition to penalty, we will also not initiate any prosecution. So this is a rectification which they have made, just to be in sync with the earlier provision. So now if you have missed out disclosing any asset below 20 lakhs, that asset is not an immobile property, because if it's an immobile property, then these provisions are not applicable. You will be subject to penalty and prosecution. But if the asset is not an immobile property, it is below 20 lakh, you can get assurance that no penalty is there. And now with this amendment, no prosecution also is there. So that's a small amendment which they have made. And I think the last slide before we end this, there are some minor changes in terms of the direct tax proposals. This is especially relevant to the next year. What they are effectively clarifying is that if you are an individual HUF, AOP, which is availing a SEZ tax holiday under the current act, we will give you the same tax holiday in the new act. This is more a clarificatory provision, I believe, because under the repeals and savings, you could well have argued that those benefits continue. And second, they had come up with the tonnage scheme last year for inland transport. So if a ship is moving within India, within the inland waterways, it can still get some tax benefit under the tonnage scheme. There were certain linkages missing to the Inland Waters Act, so they have made certain administrative changes. So no change in concept, and it's the tax holiday or the tax benefit continues, but they have changed the administrative linkage and brought the correct act, which is the Inland Water Act. Earlier it was the Merchant Shipping Act. Again, a technical error which they have made. I think this is all on the direct tax front. Thanks a lot. If there are any questions, happy to respond to that. Thank you. Yes, sir.
Sir, I am N.S. Srinivasan, Chartered Accountant. Just a few queries. I hope Chair will permit me to raise 4 or 5 queries. See, in respect of buyback, now they have said it is taxable as capital gain. The query is whether the entire consideration received will be treated as capital gain, or can I claim some cost of acquisition against capital gain, as per the scheme of computation of capital gain?
Yeah, no, you can take the benefit of cost. So it goes back to the original methodology of computing capital gain, sale proceeds minus cost.
Yes, sir. Then in respect of updated returns, now they have said you can even file UDRs for reduction of the loss amount. But whenever there is I am filing the UDR for increasing the income, I have to pay additional tax. Similarly, when I reduce the loss, I don't think any provision is made for paying additional tax.
Absolutely. No tax should come.
Yes.
Exactly. You're right. Yes.
It is restricting the future amount of tax that could be saved.
Yes. Because if you apply the tax, you might have to recover from the government.
Yes. Then regarding this undisclosed income asset scheme, of course, while they have defined the term undisclosed income and undisclosed assets, they have not defined assets which were acquired out of disclosed income. They have simply added that category in the table. Perhaps they wanted to give the benefit of disclosing the assets which were acquired abroad out of income which has suffered tax in India. That I agree. But there only one small issue. Supposing I have acquired those assets in the names of minor children and they have fetched some income. At present, I don't think there is any provision in even Schedule A to include those assets. So whether this scheme will cover such assets also, or I can simply forget about it. Because for such income in the name of minors, clubbing provisions apply.
That's a very good point, because the clubbing provision applies for income, not for disclosure. Conservatively, we used to add the disclosure of those assets, right, with a separate letter being filed saying that I have also included the details of my minor. But on a very technical position, those are not my assets, those are the assets of the minor.
Yes. Then the next query is, in respect of TDS provisions, they have brought one welcome amendment. So far, in respect of payments made to non-residents, especially for purchase of properties, you have to obtain TAN number and then recover the tax. Now, they have allowed that to be paid through an automated challan, as you do for 194.1A and 194.1B. But my query is whether even in such cases, the persons who make the payment, they can go for that automated 197 facility.
Answer is yes, they can apply, but we'll have to wait and watch for the scheme to be announced. But it seems, if you look at the memorandum, they are probably saying that we will create some kind of a automated system to get a lower withholding. My suspicion there, sir, is that there they might come up with some conditions where only few scenarios might be covered. Because a scenario where you are applying for a lower withholding for payments to a non-resident, I have my doubts. But of course, today the law framework is wide. They can come up with something, So what framework they come up with will become critical.
Because the reason is, as of now, the taxpayer, persons who make the payment, they are recovering TDS on the gross amount of sale consideration.
Yes.
They are unable to take into account the cost and other related expenses.
Unless you like the house too much. If you like the house too much, you will even give a 50 for a benefit to the seller. Yes. Of course, this was on a lighter note.
Yes, sir. Then regarding this combined assessment and penalty orders, okay, they pass the orders and we go on appeal. Then in the appeals, they allow some partial relief. So obviously they have to pass OGE. While passing the OGE, whether they will have to reduce the quantum of penalty also.
They will have to.
They will have to.
They will have to.
Okay.
In fact, I expect that now before the first adjudicating authority, you will appeal everything, right? Which means you will hopefully have a speaking order even on the quantum of penalty.
Yes.
But assuming you have not appealed penalty, let's say for a moment, right? The OG will of course have to take into that account.
Then regarding reassessment cases, where it has been set aside because of the controversy between JAO and FAO, wherever the high courts have already struck down the assessments on this ground, whether they can do a data mining and revive those cases. That
Pretty interesting. The question is that the law has been made retroactive, and when the High Court had struck down that order was valid at that time. By virtue of the High Court order, the reassessment proceedings have cost. Now the question is, merely because there is a change in law, due to change in law, can a tax officer initiate any reassessment, to which there are certain judicial precedents that a change in law, if that is the basis, is regarded as a change of opinion. And you might argue in a technical manner that a reassessment for a change in opinion may not be possible. That could be your argument, basis certain judicial precedent. Unless the government again brings a retroactive amendment saying that this is something which is not to be considered, Yeah. Yes.
The 10% payment for stay, whether it is mandatory like indirect taxes or it is discretionary, because 20% is discretionary now.
See, 10% is not mandatory because it comes under a circular, right? Which means very theoretically, if you are able to demonstrate that I am in a dire financial crisis, they can do away even with the 10%. In practice, we know it is not that easy, but 10% is not a mandatory number.
Like
it is a cap. If you read it, it's a cap. Yes. Yes. Yes, thankfully. So have not touched. Yeah, so no change in AMT.
Okay, sir. And also the follow-up questions for foreign companies, you can carry forward the MAT and set off. That's one part to it.
Yes, but only the MAT which you have paid up to 31st March 26. So any MAT paid by the foreign company in the new act is a final tax, not subject to carried forward.
Okay. My question was, assuming during the year we are a domestic company and we are trying to tie break and become a foreign company next, can I set off the MAT in the subsequent year being a foreign company?
You can, obviously, because when you enter 1st April 26, unless you are telling April Fool to the tax office, you obviously can carry it forward. I have not seen a domestic company becoming a foreign company. I have seen a foreign company becoming domestic company.
Just for the semi.
No, absolutely. I think the definition might make it a bit challenging, but if you are able to surmount that, absolutely it's possible what you said. Yeah.
Hi, sir. Can we file a updated return claiming refund of taxes?
No.
And for this allowability of SEZ deduction, so you said this is shifted into the new tax regime to allow for individuals HUF and all. I believe under the old regime, this is under 10AA claim. So 10AA has a sunset clause.
Yes, it will be subject to that sunset clause.
Okay.
Because there is a possibility where the sunset has not triggered in case of few
it's
people.
It's 2021. The company should have commenced by 2021. So, I mean, there's no point of having this if the sunset clause is still there.
No, so let's say somebody starts in 21, you might still have, a 5+5 year window. Probably they are trying to cover that case, I suspect. Probably. To my mind, there are very few such individuals and all, which take benefit. But I think it would be very few cases. Okay. But just on that refund case, while you cannot file an updated return for claim of refund, we have seen paper applications being filed saying that under the constitution you cannot, even if I have erroneously paid a higher tax, right, you cannot hold back that, which is bound to reject. So you file a paper application under 237, which you will file it in a writ. So that's how we keep that issue alive per se. Right. No, they can. And I'm saying that while you are constrained by procedure, if that refund is due conceptually, the tax office cannot hold it back, citing the lack of procedure available. So you might file a white paper application, which they don't understand. And when they reject it, you file a writ against that. Yes, 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 yes. Yes. On a lighter note, the unjust enrichment applies to the taxpayers, not to the government, because they're, but under constitution, they cannot hold back any money which they are not allowed to do it, even though I make an error. So, yeah.
Sir?
Yes, sir.
The delay in filing of the tax audit earlier was under penalty, now it's become a fee. Okay, so basically now it's like if the delay is there, there's no way out. There is no representation or whatever, and you have to pay the fee. That's how it is, right?
Not really. I think the principles may still apply. Theoretically, if you want
because
to
when the term penalty has now changed to a fee, then it is like the taxpayer, the tax officer would always say that this is it's not a penalty. It is a charge which you have to pay. That's it.
See, there are certain decisions more in the context of indirect taxes where the terminology of a fee does not take away the penal nature of that. So very technically, I do believe the tax officer has the discretion, because while they are calling it a fee, I would still think it's a penal this thing.
Now, for example, if there is a delay in filing of return, they charge the 5,000 or 10,000, whatever, 234 F we pay.
Yes.
Now that there is no discretion at all. There is no, the date is crossed, that the timelines in the monitor is changed.
Yeah.
That's all. Then you end up paying the fee.
Yeah.
So I think so. It is going to be in that line only.
Yeah. And in real world, yes, but theoretically, if that amount was huge and you wanted to, let's say, create a reasonable cause, I would believe that that fee is still a penalty. They are changing the terminology. That is my view.
Thank you.
But I am saying for 50,000, 1 lakh, nobody is going to, fight it. But see, merely because you change the term, I think the debate we are having is that they are now calling the penalty a fee, right? But where is it written that fee is something which has to be mandatory levied per se? So there have been cases where you can apply and you can get everything waived off. For small amounts, nobody is going to do it. So unfortunately, we will not see a jurisprudence. But I still see it more in the penal nature. Yeah.
So no, this is actually when it is fee, it has to be pre-front. You have to pay. Only then the tax audit return or tax audit report will be uploaded. That will be the position that we will be end up. So unless you make the payment, if there is a delay of 1 year, 1 month, that's 75,000. Beyond that, it is going to be 1.5 lakhs. Unless you make the payment, you will not be able to upload the tax audit report. That is my view.
No, you are right. So I'm saying procedurally they will make it mandatory, but under concept, if you believe there was a valid reason why I could not file it, right? You could challenge it under a writ, saying that this fee is not something which should be allowable. And you also have the powers to the CBDT under 119 where you can apply for a relief. So my view is they are calling it a fee, but effectively the quantum is still a penalty per se. Yeah. Yeah. Yes.
Non-Indian income will be exempt. So that's one provision which I was able to see. My question is, will it lead to treaty shopping? Because certain treaties say that, for example, royalty will be taxed in the state in which the resident resides. So will it somehow lead to treaty shopping if this happens?
Sorry, can you...
So the non-resident coming to India for a longer stay,
sure.
The Indian in India, the income outside India will not be taxed. So assume I have intellectual property outside India and I'm coming, is being paid. So automatically I'll get an exemption in India too. So can I come to that conclusion with that amendment?
You're talking about the scheme which they are
Yes.
talking about it. Yes. I'm not aware how will they create a framework, because I'm sure they'll create detailed rules. But assuming they give you an absolute flat exemption, right? then whatever your overseas income are there, be it royalty or whatever, should be allowed as a exempt income. And I believe that people who are moving to India, right, would move for very genuine reasons. So I suspect it might be very difficult for somebody to deny that, saying that you are doing a treaty shopping. I think it's more, it looks like to get some high-end AI scientists, technologists, medical researchers back into India. But for which I believe 5 years is not enough, because in any case for the first 2 years, they are not subject to tax on their overseas income, because they will be a resident but not ordinary resident. So in reality, you are giving them an additional 3-year RNOR status. I don't know whether that's enough. But if they give, I don't think the overseas income would be questioned, saying that you have designed something. Hopefully, that's.
Sir.
Yes.
While dealing with the denial of deduction for interest against dividend income, you are raising the issue of whether the interest can be claimed as a cost or not. If you see the analogous situation of sale of an house property, now at present there is a proviso in section 48 to say that you cannot claim deduction for any amount of interest which is claimed under section 24.
Yes.
Which means indirectly they are saying that whatever is not claimed under section 24 can be added to the cost. There are also certain tribal and high court decisions supporting that view. Can we take those decisions as precedents as well as the proviso itself to say that interest which is not allowed as deduction against income from other sources should be at least added as a cost of improvement?
So you have decisions which confirm what you are saying. I will tell you my reservation. Normally the term cost is not defined. So if you go by the Supreme Court, Tuticorin and all those decisions, you have to give an accounting meaning to the cost. So if I have borrowed money today and I have started incurring interest, and after 7 days I have bought an asset, let's say shares of Reliance, then definitely the cost of interest for 7 days can be added to the shares. But once I have bought Reliance, any subsequent interest cost has no bearing on my holding of asset. So my personal view is any subsequent interest cost should not be added to the cost of Reliance from a pure accounting perspective. But you have decisions where I'm presuming the judges are not accountants. So they have said, yes, why not take the benefit,
Sir,
yeah.
Then regarding this fee, if it is not in the nature of penalty, can we claim deduction for that in computing the income from business or profession by bypassing the prohibition under section 37? And similarly, in the previous session, he informed that in Customs Act, the term penalty has been replaced by the term charge. So will that amount also be allowed as a deduction under section 37?
See, normally in 37, there is one proviso which says that any payment made for violation of any law is something which is disallowed. The question is, if I have violated a law which is filing the return in due date and I have exceeded that timeline, could that be disallowed? My sense is that you may not be able to claim that as a deduction under 37. So that might be a bit tricky. First, because as I said, my original view is it remains a penal payment. Second is, can somebody says it's in context of violation of a law which is expressly disallowed under 37. Yeah. Thank you. Thank you.
Thank you, sir. I would like to invite CA.K. Ravi, sir, a past chairperson of SIRC of ICI, to deliver the vote of thanks.
Post lunch, even in classrooms, I have slept. The measure of success of a speaker should be judged by the fact that he's been able to hold the audience and hold them alive and hold them awake. If that is the measure of success, I think the afternoon speakers have achieved that purpose. Particularly post lunch, it's a matter for sleeping. I've suffered that. But coming to one or two issues, Jaufau, Din, all these things, one batch, Justice Nagaratna bench with Ujjal Boyan have sent it back to the high courts. Now the high courts, when they come, this pleading is not there, whether it is retrospectively valid or not. So now one timeline for filing additional pleading or amending the writ petition, etc. will come. Thereafter it will be taken up, and then whether you say that this is the retrospective amendment, yes, possible. Whether you can make it retroactive because there was a vested right in me and therefore you can't take it away. But go back to 2012 Vodafone, they took advantage of a prospective DTC and said, yes, we'll use this to give a favor to Vodafone. So similarly, can they take away a favor if you call it a favor? That issue will now crop up. So there is enough litigation on that front, particularly where the amounts are large. Somebody was asking about this payment for belated filing. I believe it is in the nature of a penalty, but if you say no, it's not in the nature of penalty, but it's only a fee or a cess or whatever it is, then maybe 37 you can still claim, because if they're saying this is the timeline by which you will file a return. If you don't file, pay something more, I will accept it. Is that not what they are saying? Therefore, it should be an allowable deduction according to me. Typically of, what happened in those days where the transport operator claimed that I have to pay mamuls at the check post. He was paying it. So this retrospective amendment issue, again, if it is only before the tribunal, you can't claim you can't challenge the constitutional validity before a tribunal, but possibly, you claim that it's a vested right which is being taken away, and therefore the law cannot operate retrospectively. Years back, 143, 1A was there, but if your loss got reduced on that, they say you must pay 20%. I had a matter where this happened. I said they can't do it retrospectively because I'm worse off than what I was on the date I filed my return, and therefore probably prospective. The tribunal agreed with my view that you can't make it, you can have a law retrospectively, but you can't make it retroactive. And if I remember, the name's case was Shakira West Garments, but something beautiful turned out of it for my pride. Justice Ruma Paul, then the second senior most judge of the High Court, Supreme Court, was here to go through this tribunal selection, member selection. And then she sent word for me. So, a Supreme Court judge calling you, you're scared here. So I quietly went, sitting literally, I don't know how many of you saw Arnab Goswami interviewing Jayalalitha. He was sitting at the edge of the chair. If you see that. That's how I was sitting. So I know how it means. So I slowly gave her my card. She played carom board with it, tuck, she returned it. I was wondering what's happening. Next 30 seconds, my life went. Then she said, did you argue Shakira West Garment? I said, yes. Matter came up from Guwahati High Court on a different issue, on a different case. But I think the principle is right. You must shift as an advocate. That is the trigger point for me to shift out of this profession and go as an advocate. Ladies and gentlemen, I think we should put our hands together for an excellent session by Rohit and Vishal. I'm honestly proud, and I say this with a lot of this thing, that somewhere I have been able to pick on the right people. I picked on Rohit Jain. I told him you bring somebody for direct access. He's got the right person. So possibly if you choose one rightly, it will lead you along the track. Thank you, Vishalji, for an excellent session. And I'm sure whenever the SIRC calls you, you will be back in action here. Thank you, ladies and gentlemen.
Thank you, sir. Have a pleasant, nice evening.